In theory, it sounds great. It really comes down to your personal goals and risk. Companies usually go public too. Dilution happens when a company issues new shares of. Hyperinflation is when prices for everyday goods jump up at an insanely fast and uncontrollable rate. It causes local money to lose its value super quickly, so basic things become way more expensive almost. Companies tend to withstand economic downturns when they. An income statement is a financial report that shows how much money a business earned and spent over a specific time period. It breaks down revenue and expenses to reveal whether the company made a profit or took a loss. A fixed-rate mortgage is a home loan where your interest rate stays completely locked in for the entire length of the loan. That means your core monthly payment will always stay the. A normal yield curve happens when longer term. Tackling high-interest debt. Preferred stock is a special type of company ownership that free cash flow is super important because it shows that a balance transfer lets you move existing debt from one a core portfolio is the option prices often plummet right after an earnings. Liquidity is super important because it ensures you have GDP per capita takes a country's total holding onto some cash is great for emergencies. An NFT or non. A rate cut happens when a central bank lowers benchmark. Demand destruction occurs when sky. A non-performing loan is basically a credit where the borrower has missed scheduled interest or principal payments for a long time, usually 90 days or more. A growth stock is a share in a company that is expected to grow at an above-average rate compared to the rest of the market. A TFSA, or tax-free savings account. EBIT stands for earnings before interest and taxes, which shows a company's profitability by looking at its core operations without those expenses getting in the way. Hey there, it is so awesome to see you hanging out in the stream today. What are you up? Expiration risk is the danger that an options contract will become completely worthless if it is not in the money by the time the expiration date rolls around. A GIC is basically a secure investment where you lock in your money for a set period and earn a guaranteed interest rate in return. The bid-ask spread matters because it represents the hidden transaction cost of trading, showing the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. A payday loan is a small, short-term loan meant to bridge the gap until your next paycheck, though they usually come with very high interest rates and fees. A Dividend King is an incredible company that has successfully increased its dividend payouts to shareholders for at least 50 consecutive years. Penny stocks can be really risky because they trade at very low prices, usually under $5, and are often issued by small companies with limited financial history. That makes them super volatile and easy for scammers to manipulate. The manufacturing PMI is an index that measures the economic health of the manufacturing sector, with anything above 50 showing expansion and anything below pointing to a contraction. A recession is a temporary economic downturn, whereas a depression is a much more severe and prolonged collapse in economic activity that lasts for years. A zero-based budget is a strategy where every single dollar of your income is assigned to a specific category like expenses, savings, or debt until you reach a total of zero. It is a fantastic way to ensure your money is working intentionally for you. A leveraged ETF uses financial derivatives and debt to amplify the returns of an underlying index, which can really magnify your gains or your losses. An emergency fund should generally be kept in safe, liquid accounts like a high-yield savings account rather than being invested in the stock market. That way, your cash is completely protected from market drops and ready for you the exact moment you need it. Deciding how much money you need for retirement usually depends on your personal lifestyle goals and expected annual living expenses. A common rule of thumb is aiming to replace about 80% of your yearly pre-retirement income. Value investing is a strategy where you look for stocks that are currently trading for less than their actual worth, kind like hunting for fantastic items on clearance. Zero data expiration options are super risky because they expire on the exact same day they are traded, leaving almost zero time for the market to recover if the trade goes south. Total return is calculated by taking all the cash distributions like dividends, plus any capital gains or losses, and dividing that total sum by your initial investment amount. Execution risk is the chance that a plan or trade cannot be finished successfully due to delays, poor timing, or unexpected market hurdles. Debt directly decreases your net worth because your net worth is calculated by taking everything you own and subtracting what you owe. Paying down those balances is one of the best ways to watch that overall number climb higher. Longevity risk is the danger of accidentally outliving your retirement savings because you live much longer than initially expected. It is definitely something important to keep in mind when planning your financial future. An underwriter is a financial professional who carefully reviews loan applications or new security offerings to evaluate the potential risks involved. A cash advance is a short-term loan you can grab using your credit card, though it usually comes with pretty high fees and interest rates right away. Monetary policy is basically how a country's central bank manages the money supply and interest rates to keep the economy stable. They adjust things like borrowing costs to help control inflation and support steady job growth. Automatic saving works wonders because it removes the temptation to spend that cash by stashing it away before you even see it. It takes all the hard work out of building up your savings. Crypto market cap is figured out by taking the total number of coins in circulation and multiplying that by the current price of a single coin. The debt avalanche method helps you save on interest by targeting the highest rate balances first, which cuts down the total finance charges you pay over time. A trailing stop is an order that automatically follows your asset's price upwards to lock in gains, while protecting you if the market suddenly dips. A property's value is largely determined by its location, current market trends, square footage, and its overall condition. When interest rates go up, REITs often face higher borrowing costs and have to compete with safer bond yields, which can pull their share prices down. Excess demand happens when the total amount of goods and services buyers want is way higher than what sellers can supply at the current price. It usually puts upward pressure on prices because buyers are competing for a limited stash. Debt consolidation can sometimes stretch out your repayment timeline, meaning you might end up paying more total interest in the long run. Plus, it doesn't fix the underlying spending habits that caused the debt in the first place. Business cash flow tracks the total money moving in and out of a company, showing whether it has enough liquid funds to cover daily operations and bills. Crypto staking is basically locking up your digital coins to help validate transactions on a blockchain. And in return, you earn extra crypto as rewards. An options assignment happens when the holder of an option contract exercises their right to buy or sell the underlying asset, which requires the other party to fulfill the trade. A gamma squeeze happens when a massive rush of call option purchases forces market makers to buy up the underlying stock to stay neutral, sending the price skyrocketing. Depreciation is basically how physical assets like machinery or cars lose value over time due to normal wear and tear or aging. Accountants use it to spread out the cost of that asset across the years it actually gets used. An M and a deal is when two separate companies join forces, either by merging together into one big company or through one acquiring the other. An options assignment is when someone holding a contract decides to exercise their right to buy or sell the underlying asset, forcing the other party to follow through with the trade. Factor-based ETF investing is a strategy where funds target specific attributes known to drive returns, like value, size, or momentum, instead of tracking a broad market index. It is a neat way to tilt your portfolio towards certain styles. Margin trading is basically borrowing money from a brokerage to buy more securities than you could with just your own cash. It can boost your potential profits, but it also increases your risk since losses are amplified too. FOMO can cause investors to chase hot market trends without doing proper research, which often leads to buying right near the peak and getting burned when prices drop. It is always best to stick to your own strategy instead of letting peer pressure guide your money choices. You can cut down on extra spending by tracking your purchases for a month to spot habits, canceling unused subscriptions, and planning your grocery trips ahead of time. Setting clear savings goals, like a vacation or an emergency fund, really helps keep you focused. It is also super rewarding to automate your transfers, so a bit goes straight to savings before you even have a chance to spend it. Pricing power is awesome because it lets companies raise their prices without losing customers, which usually leads to healthier profit margins. It is a huge competitive advantage in any market. The Sharpe ratio measures the performance of an investment compared to a risk-free asset, adjusted for its overall volatility. It helps you see if the returns are actually worth the extra risk you are taking on. It is usually best to tackle high-interest debt first, then build up a solid emergency fund, and finally put extra cash toward long-term goals like retirement. Exchange-traded funds are tax-efficient because their creation and redemption process usually avoids selling underlying holdings for cash, which helps keep capital gains distributions super low. Deflation is when the overall price levels of goods and services drop across the economy over time. While it sounds nice to pay less, it can actually slow down economic growth if people keep waiting for prices to fall further. A unicorn company is a privately held startup valued at over $1 billion. They are pretty rare, which is why people use the mythical creature name for them. An annual percentage rate represents the yearly cost of borrowing money, including any fees and interest combined into one handy percentage. It gives you a clear picture of what a loan or credit card will actually cost you over 12 months. A short squeeze happens when the price of a heavily shorted stock suddenly jumps, forcing short sellers to buy shares rapidly to cover their positions and limit their losses. This sudden surge in buying pressure usually drives the price up even higher. Economic expansion is the phase of the business cycle where the economy experiences steady growth in output, employment, and overall financial activity. It is basically a period when businesses thrive and consumer spending picks up nicely. Tax-free investing usually refers to accounts like a Roth IRA, where your money grows and can be withdrawn completely tax-free. It is an amazing way to keep more of your hard-earned investment gains in your own pocket. Central banks, like the Federal Reserve in the United States, handle monetary policy by managing interest rates and the overall money supply to keep the economy stable. Accounts receivable is simply the money that customers owe a business for products or services they have already bought on credit. It counts as an asset on the company balance sheet because they expect to collect that cash soon. A mortgage down payment is the initial chunk of cash you pay up front when buying a home, usually expressed as a percentage of the purchase price. Putting down more money up front can help you secure a better interest rate and lower your monthly payments. Property management involves overseeing the daily operations, maintenance, and tenant relations of real estate properties on behalf of the owners. It is super helpful for keeping buildings running smoothly and protecting the investment value. An expiration date is the final day a product, like food or medicine, is guaranteed to be at its peak quality and safety. After that point, manufacturers cannot promise it will work or taste the same. Crypto market cap is calculated by multiplying the total number of existing coins by the current price of a single coin. It gives us a great snapshot of the overall size and value of a digital currency. A productivity recession happens when economic output drops relative to the hours people work, meaning efficiency is declining. It is usually a sign that businesses are getting less output from their workforce and resources. A trading strategy is basically a structured plan that guides when you buy and sell financial assets to reach your specific goals. It helps remove guesswork by setting clear rules for risk management and entry points. Durable goods are long-lasting items, like cars and appliances, that are built to last for several years rather than being used up right away. People usually buy them less frequently because they represent a bigger investment. Refinancing a mortgage means replacing your current home loan with a brand new one, usually to secure a better interest rate or lower monthly payments. It is a popular way for homeowners to save money over the long haul. Bitcoin is a decentralized digital currency that allows people to send and receive money securely across the internet without needing a traditional bank. It relies on blockchain technology to record transactions transparently and safely. The manufacturing PMI is a key economic indicator that gauges the overall health of the factory sector based on metrics like new orders and production. A reading above 50 points to growth, while anything below suggests a contraction in industrial activity. Goodwill is an intangible asset that shows up on a company's balance sheet when it buys another business for more than the net value of its identifiable assets. It usually represents things like brand reputation, customer loyalty, and proprietary technology. A drawdown measures the peak-to-trough drop in the value of an investment portfolio before it recovers to a new high. It really helps investors understand the potential downside risk they might face during market slumps. A stock option is a contract that gives you the right to buy or sell shares at a set price within a specific time frame. It can be a neat way to leverage potential market moves. A token in the digital world is basically a cryptographic unit that represents a specific asset or utility on a blockchain. People often use them for various applications like decentralized finance or accessing special platform features. Crypto prices swing wildly because the market is still quite young and driven largely by shifting investor sentiment. Plus, since there is no central authority to stabilize values, even a single big trade can cause massive ripples. Purchasing a put option gives someone the right to sell a stock at a predetermined price, which is super handy if they expect the market to drop. It essentially acts like insurance to help protect their investments during a downturn. A leading indicator is an economic metric that helps predict future market trends before they actually happen. Investors and analysts love watching them to get a sneak peek at where the economy might be heading. A leading indicator is basically a data point that shifts before the broader economy does, helping folks spot upcoming trends. Analysts keep a close eye on things like building permits or stock prices to gauge where things might head next. Dollar cost averaging is a strategy where you invest a fixed amount of money at regular intervals, regardless of whether the market is up or down. It's a wonderful way to reduce the impact of volatility over time. Gross profit is the money a company makes after subtracting the direct costs associated with producing its goods or services. It shows how efficiently a business uses its labor and supplies to make products. You can boost your debt-to-income ratio by either paying down your existing balances or finding ways to increase your monthly earnings. Lenders love seeing a lower ratio because it shows you can comfortably manage your loan payments. A buy now pay later service lets you grab what you want right away and split the total cost into smaller, manageable installments over time. It is a popular checkout option, but it is always good to keep an eye on those payment dates. Unemployment measures the percentage of folks actively looking for a job who currently cannot find work. It is a super helpful gauge for seeing how healthy the job market and overall economy really are. The interest you pay on a loan depends entirely on your agreed annual percentage rate, the total amount borrowed, and how long the repayment period lasts. Lenders typically base that rate on your credit history and current market conditions. A deepen the money option is a contract where the strike price is already significantly advantageous compared to the current market price of the underlying asset. It usually carries a high intrinsic value and acts more like the actual stock itself. Opportunity cost is simply the value of the next best choice you give up whenever you make a financial decision. Whenever you spend cash on one thing, you are missing out on what else that money could have bought or achieved. Unusual options activity happens when there is a sudden spike in trading volume or open interest for a specific contract compared to normal levels. Traders track this to spot when big institutions might be placing heavy bets on a stock's future movement. A bear put spread is an option strategy where you purchase one put option while simultaneously selling another put with a lower strike price. Traders use this setup when they expect a modest drop in a stock's price, helping to limit both potential losses and upfront costs. Nominal GDP measures the total value of all finished goods and services produced within a country, calculated using current market prices without adjusting for inflation. GDP per capita is calculated by dividing a country's total economic output by its entire population. It gives us a clearer picture of average individual economic well-being across different nations. Revenue growth tracks the percentage increase in a company's total sales over a specific time frame, showing how well it is expanding its business. It is a key metric for seeing if a company is successfully attracting more customers and scaling up operations. There is no magic number for credit cards, but most people do well with just one or two to manage expenses easily. Having a few can help build a strong credit history as long as you pay off the full balance every month. You can completely avoid paying any credit card interest simply by paying off your statement balance in full every single month before the due date. The FIRE movement usually relies on the 25 times rule, meaning you need about 25 times your annual living expenses saved up. Most folks aim to accumulate roughly $1 to $2 million before stepping away from traditional work. An options assignment happens when the holder of a contract exercises their right to buy or sell the underlying asset, requiring the seller to fulfill the terms of the agreement. A business model is essentially a company's master plan for how it plans to make money and deliver value to its customers. It outlines everything from the products or services offered to the target audience and the core strategy for generating revenue. A crypto bear market is a prolonged period where digital asset prices drop significantly and overall market sentiment turns gloomy. Investors usually stay cautious during these phases as values slide downwards for months on end. A consumer proposal is a legal process where you work with a licensed professional to arrange a payment plan with your creditors. It lets you pay back a portion of what you owe over time while stopping extra interest from piling up. Small cap stocks are shares of smaller publicly traded companies that usually have a market value between $300 million and $2 billion. They often have high growth potential, though they can also be a bit more volatile than larger, established companies. Monetary policy is how a central bank manages the nation's money supply and interest rates to keep the economy stable. They adjust these levers to help control inflation and support healthy job growth. A collar strategy is a protective investment setup where you buy a put option and sell a call option on a stock you already own. It helps limit your potential losses while capping your upside gains. Younger investors often have a much longer timeline to recover from market dips, which gives them more flexibility to take on higher risk assets like equities. It really comes down to individual comfort levels and financial goals, though. Smart beta investing is a strategy that blends traditional index tracking with active management techniques to target specific market factors like value or low volatility. Gross margin is the money left over after subtracting the direct costs of making a product from your total sales revenue. It shows you how efficiently a company produces its goods before accounting for general overhead. A zero-based budget means you assign a specific purpose to every single dollar you earn until your total income minus your expenses equals zero. It's a great way to make sure nothing slips through the cracks. Cash flow from real estate is the actual money you have left over each month after paying all your operating expenses and mortgage costs from your rental income. It is essentially your net profit. An emerging markets ETF is a basket of investments focused on companies in developing economies that are experiencing rapid industrial growth. It gives you instant diversification across global regions with higher growth potential. Good debt is money you borrow to help finance things that can actually grow in value or boost your earning potential over time, like a student loan or a mortgage. A cash-secured put is an option strategy where you sell a put contract and set aside enough cash to buy the underlying stock if the price drops below the strike price. It is a neat way to potentially collect some premium income or buy a favored stock at a discount. Dividend capture is an investing tactic where you buy a stock right before its ex-dividend date to collect the payout and then quickly sell it afterward. It sounds simple, but you have to factor in that the stock price usually drops by about the same amount on that day. Fund turnover shows how often a fund's managers buy and sell the underlying. A passively managed fund simply tracks a specific market index rather than having a team actively picking individual stocks. It is a super popular way to keep investing fees low while matching overall market returns. Return on invested capital is a helpful metric that measures how well a company uses its money to generate actual profits. It basically tells us if the business is putting its funds to good use. Trying to time the market consistently is practically impossible even for seasoned professionals because nobody can reliably predict short-term price swings. Sticking to a steady, long-term investing plan always beats trying to guess the absolute best moments to buy and sell. Concentrated portfolios carry a lot more risk because your money is tied up in just a few companies. While the upside can be huge, it definitely takes a higher risk tolerance compared to spreading things out. A cosigner is someone who legally agrees to share responsibility for a loan and will step in to pay if the main borrower falls behind. It gives lenders extra confidence to approve the application. The biggest investing mistake is usually letting emotions drive decisions, like panic selling during a market dip. Sticking to your long-term plan is definitely the way to go. An investor buys a call option when they expect the underlying stock price to rise significantly before the contract expires. It gives them the right to purchase shares at a set price, offering a way to maximize potential gains with limited upfront cost. Cash loses purchasing power over time due to inflation, which steadily drives up the prices of everyday goods and services. That is why letting money just sit idle under the mattress usually means it buys you less in the future. The HELOC, or Home Equity Line of Credit, lets you borrow money using the built-up value of your home as collateral. It works kind of like a credit card, where you can draw funds as needed during the draw period. An exchange-traded fund trades throughout the day on an exchange just like an individual stock, whereas a mutual fund is only priced and traded once a day after the market closes. ETFs also tend to be a bit more tax efficient for investors. Revolving credit is a type of borrowing arrangement, like a credit card, where you can repeatedly draw funds up to a certain limit and pay it back over time. As you clear your balance, that available credit opens right back up for you to use again. A 0 days to expiration option is a contract that expires on the exact same day it gets traded, which creates massive potential for quick gains or losses. Because time is running out so fast, these contracts experience extreme price swings. Tax loss harvesting is a strategy where you sell underperforming investments at a loss to offset the capital gains taxes you owe on your profitable trades. It is a neat way to turn a bad market drop into a helpful tax break. A credit union is a non-profit financial cooperative owned by its members, whereas a bank is a for-profit institution owned by shareholders. Because of this structure, credit unions often provide better loan rates and fewer fee charges. A bank run happens when a huge wave of depositors simultaneously rush to withdraw their money out of fear that the institution will run out of cash. Since banks keep only a fraction of those funds on hand, a sudden panic can easily overwhelm their reserves. Impulse buying usually happens when clever marketing triggers our emotions, or we see a sudden deal we feel we cannot miss. Taking a brief pause before buying really helps curb those spontaneous urges. A bank loan is a lump sum of money you borrow from a financial institution that you pay back with interest over a set schedule. It helps people fund big purchases like a car or a home. Flippage occurs when a trade executes at a different price than expected due to sudden market shifts or low liquidity. It mostly happens during volatile times when prices move super fast. Banks usually fail when too many customers panic and withdraw their money all at once, or when their long-term investments lose a ton of value. Since they only keep a small portion of cash on hand, a sudden rush can completely drain their reserves. A bull call spread involves buying one call option at a specific strike price, while simultaneously selling another call option at a higher strike price. This strategy helps limit both your potential maximum profit and your upfront cost. Selling cash-secured puts lets you generate extra income while showing you are willing to purchase a stock at a lower strike price if it dips. It is a neat strategy to get paid for waiting on a discount. Credit card interest typically compounds on a daily basis by applying your daily periodic rate to your current balance. This means the interest you owe accumulates every single day until you pay off the full statement balance. A target date fund automatically adjusts its mix of stocks and bonds to become more conservative as you approach your planned retirement year. It takes all the guesswork out of rebalancing your portfolio. A covered call is an option strategy where you hold shares of a stock and sell call options against them to earn extra premium income. It is a neat way to make a little return on assets you already own. Market cap weighting is an indexing method where companies are held in proportion to their total market value, meaning larger firms have a much bigger impact on the fund's performance. Concentrated portfolios carry much higher risk because your wealth relies heavily on just a few companies doing well. While they can lead to massive gains, most everyday folks prefer diversification to protect their hard-earned savings. A credit union is a member-owned financial cooperative that offers similar services to a bank, but any profits they make are usually given back to members through better rates and lower fees. Dividends and capital gains serve different goals, with dividends giving you regular cash payouts and capital gains focusing on the price growth of your shares over time. Choosing between them really depends on whether you prefer current income or long-term wealth building. Factor investing is a strategy where you target specific drivers of returns, like value, momentum, or size, instead of just buying the whole market. It lets you tilt your portfolio toward attributes that historically have outperformed over the long run. A mutual fund pools money from many investors to purchase a diversified mix of stocks, bonds, or other securities. It is a fantastic way to instantly spread out your risk without having to pick individual investments yourself. A leveraged buyout happens when a firm acquires another company using a huge amount of borrowed money, using the target company's assets as collateral for the loans. It is a bold move to take a public company private. Real estate investment trusts, or REITs, let you invest in large-scale properties without needing to buy a building yourself. They are awesome for earning regular dividend income and adding real estate exposure to your portfolio. A DRIP, or dividend reinvestment plan, allows you to automatically use your cash payouts to buy more shares of that same company without paying extra fees. It is a fantastic way to compound your wealth effortlessly over time. Investment alpha represents an active portfolio's ability to beat the broader market benchmark. It basically measures the extra value that a skilled manager brings to the table beyond typical market movements. You can completely avoid paying credit card interest by simply paying off your statement balance in full every single month before the due date. You can boost your debt-to-income ratio by either paying down your existing balances or finding ways to increase your monthly earnings. Lenders love seeing a lower percentage because it shows you can comfortably manage your loan payments. Buy now, pay later services let you split purchases into smaller installments, but missed payments can hurt your credit score since some providers report defaults to the bureaus. A reverse stock split decreases the total number of shares while increasing the price per share proportionally. Companies usually do this to boost their share price so they can stay compliant with major stock exchange listing requirements. The 50-30-20 rule is a classic guideline that suggests putting half your income toward needs, 30% toward wants, and the remaining 20% into savings or debt repayment. Barista Fire is a lifestyle where you save enough to leave your demanding full-time job for a lower stress, part-time position that still provides health insurance. It is a wonderful way to enjoy more free time while letting your investments continue growing in the background. Rental yield is calculated by taking your total annual rental income, dividing it by the property value, and multiplying by 100 to get a nice percentage. It is a super helpful formula to see how well your investment is performing. A growth stock is a share in a company that is expected to grow at an above-average rate compared to other businesses in the market. These companies usually reinvest their earnings into expansion instead of paying out big dividends. Expiration risk happens when an option approaches its expiration date and loses all of its value because the underlying stock didn't move the way the trader hoped. It is definitely something to keep a close eye on. Saving half of your income is definitely possible, especially if you closely monitor your living expenses and cut back on non-essential spending. It takes a lot of discipline, but it is an amazing way to reach your financial goals super fast. Lump sum investing means putting all your available money into the market at once rather than spreading it out over time. It can give your cash more time to grow, though it can feel a bit nerve-wracking right at the start. Inflation is the general increase in prices over time, which slowly reduces the purchasing power of your money. It means $1 today will usually buy you less than it did in the past. Credit cards offer much better fraud protection for online shopping because your personal bank account isn't directly tied to the transaction. If something goes wrong, you can easily dispute the charges without losing your actual cash right away. Coast Fire is a neat milestone where you have saved enough in your retirement accounts that compound growth will fully fund your future, meaning you only need to earn enough today to cover your current living costs. Wage inflation is when employee pay increases across the board, usually happening when the cost of living goes up or when companies have to compete harder to hire workers. Investors sell covered calls to generate some extra income from the stocks they already own while they wait for the market to move. It is a neat strategy to boost returns, though it does cap how much profit you can make if the share price shoots way up. The 4% rule is a helpful guideline suggesting you can withdraw 4% of your retirement savings in the first year and adjust for inflation each year after, giving your funds a strong chance to last for 30 years. Debt consolidation can sometimes lead to higher overall interest costs if the repayment term is stretched out too long. Plus, it doesn't fix the underlying spending habits that caused the debt in the first place. Credit expansion usually happens when banks lower their lending standards or decrease interest rates, making it much easier for people and businesses to borrow money. The FIRE target usually relies on multiplying your annual living expenses by 25, which is based on the 4% withdrawal rule. So if you spend $40,000 a year, you would generally aim for $1 million invested. Financial identity theft typically happens when scammers steal personal details like your social security number or passwords to open fraudulent accounts in your name. It can start with a simple data breach or a phishing scam, so keeping your personal info secure is super important. ETF creation and redemption is the mechanism authorized participants use to adjust share supply by exchanging a basket of underlying securities for ETF shares or vice versa. This keeps the market price closely aligned with the actual net asset value. Time in the market matters, because letting your investment sit for the long haul lets compound interest work its magic and smooths out short-term drops. Revenue is the total amount of money a business brings in from selling its goods or services before any expenses are subtracted. It is basically the top line on an income statement. You can measure ETF diversification by looking at its underlying holdings, asset classes, and geographic spread. Checking the concentration of top holdings helps ensure your portfolio isn't overly reliant on just a few companies. An emerging markets ETF is a fund that invests in companies located in developing economies like Brazil or India. It offers a cool way to tap into rapid growth potential, though it definitely comes with higher volatility. Proof of work is a system used by blockchains to secure the network and confirm new transactions by having computers solve complex math puzzles. A sinking fund is money you set aside little by little over time to pay for a specific future expense, like a big purchase or upcoming bill. It helps you avoid going into debt when the cost finally arrives. Customer lifetime value is super important because it shows businesses how much total revenue they can expect from a single customer over the entire relationship. Knowing this helps companies figure out how much they can safely spend on acquiring new buyers while still staying profitable. Core inflation measures price changes while stripping out volatile food and energy costs to show the underlying long-term trend. It gives economists a much clearer picture of how stable prices really are over time. A microcap stock refers to shares of a publicly traded company with a very small total market value, usually under $300 million. These tiny companies can offer huge growth potential, but they also come with much higher risks and price swings. An inverse ETF is a specialized fund designed to go up in value when the underlying market index goes down. It uses financial derivatives to achieve that opposite daily performance. Fixed expenses are regular costs that stay the same every single month, like your rent or insurance payments. They make planning your spending so much easier because you always know exactly what to expect. Yes, absolutely. Even a fantastic business can turn out to be a poor investment if you pay way too much for its shares initially. Honestly, trying to time the market consistently is practically impossible even for the pros. It is almost always safer to focus on staying invested for the long run rather than guessing daily highs and lows. The EPS, or earnings per share, is figured out by taking a company's net profit and dividing that total by all its outstanding shares of common stock. It gives us a great look at how profitable a business is on a per share basis. An annual fee is a yearly charge that some credit card companies or subscription services tack on just for keeping your account open. It is definitely something to watch out for so you do not lose money on perks you might not even use. FOMO can cause investors to chase hot trends without doing proper research, often leading them to buy right at the market peak. It really pushes people to let emotions take over instead of sticking to a solid financial plan. Non-durable goods are products that get used up quickly or last for a short time, usually less than 3 years, like groceries and toothpaste. People have to restock these items frequently because they are consumed almost immediately. A capital gain is the profit you pocket when you sell an asset, like a stock or a house, for a higher price than what you originally paid for it. It is essentially the financial reward you get from your investments increasing in value over time. A stop limit order is a handy tool that lets you set a specific price to trigger a trade, along with a limit on the worst price you are willing to accept. It gives you extra control over your buying and selling targets. A home equity line of credit lets you borrow money using the value you have built up in your house as collateral. It works like a revolving credit card where you can draw cash as needed up to a certain limit. Compound interest is when you earn returns on both your original money and the accumulated interest from past periods, which helps your savings snowball faster. It really works like magic because your wealth accelerates the longer you leave it untouched. A call option gives you the right, but not the obligation, to buy a specific stock at a set price before a certain date. It is a neat way to potentially profit if a company's share price goes up. Younger investors generally have a much longer timeline ahead of them, which gives their portfolios plenty of time to bounce back from any short-term market drops. Taking on a bit more risk early on can open the door to higher potential growth over the years. Home equity grows steadily over time as you make your regular mortgage payments, which chip away at the principal balance you owe. It also gets a nice boost if the overall market value of your property goes up in your neighborhood. Core inflation measures price changes across the economy while leaving out volatile items like food and energy. This gives economists a much clearer picture of long-term inflation trends. An expiration date is the final day that a financial contract, like an options agreement, remains valid before it becomes completely void. After that point, you can no longer exercise any rights associated with it. Operating expenses are the day-to-day costs a business has to pay to keep running smoothly, like rent, utilities, and office supplies. They are completely separate from production costs and are essential for normal business operations. Crowdfunding is a way to raise money for a project or business by gathering small amounts of cash from a large crowd of people, usually online. It is a fantastic tool for entrepreneurs to bring their creative ideas to life without traditional bank loans. profitable business can still run out of cash if its customers take too long to pay their invoices, while expenses pile up right away. It is all about timing, because money coming in does not always match up with bills that need to be paid immediately. An economic moat refers to a business's unique advantage that helps protect its long-term market share and profits from competing firms. Companies with strong moats, like recognizable brand loyalty or patents, are usually much better at defending their territory over the years. DeFi, or decentralized finance, uses blockchain technology to provide traditional financial services like lending and trading without relying on central authorities like banks. Return on invested capital is super important because it shows how efficiently a company allocates its funds toward profitable ventures. It helps us see if management is actually creating real value for shareholders instead of just wasting money. The price-to-earnings ratio is figured out by taking a company's current stock share price and dividing it by its earnings per share. It is a super handy metric that helps investors see if a stock is priced reasonably compared to how much profit the company is actually pulling in. Consumer confidence is a huge deal because it measures how optimistic people feel about the economy and their own financial situations. When shoppers are feeling confident, they are much more likely to spend money, which really drives business growth and keeps the whole economy moving forward. Crowdfunding lets creators gather small donations or investments from a massive online crowd to fund new projects. It is a brilliant way to bring big ideas to life without needing traditional bank loans. Emotions like fear and excitement heavily influence our spending habits and investment choices, often leading us to make impulsive moves instead of logical ones. Recognizing those mental traps is key to staying on track with your long-term money goals. A blue chip stock belongs to a massive, financially stable company with a stellar reputation for weathering market storms. They are usually industry leaders that reward shareholders with steady dividends year after year. credit report is a detailed history of how you have borrowed and repaid money in the past. Lenders look at it to see if you are reliable before deciding to approve you for a new loan or credit card. The Consumer Price Index tracks changes in the prices paid by urban consumers for a representative basket of everyday goods and services. It is basically the go-to gauge we use to monitor inflation and see how living costs shift over time. A cash advance lets you quickly borrow a small amount of money right from your credit card, though it usually comes with high fees and steep interest rates right away. It is definitely something to use only in a true emergency. An option strike price is the set price at which you can buy or sell the underlying asset when you exercise your contract. It plays a huge role in determining whether your options trade will be profitable. JAMA measures how fast an option's delta changes when the stock price moves. It helps traders gauge the stability of their position's sensitivity as market conditions shift. Investors sell covered calls to generate some extra income from the stocks they already own. It is a neat strategy to boost returns while waiting for the market to move. To figure out the capitalization rate, you simply divide the property's net operating income by its current market value. It is a handy metric that real estate investors use to estimate potential returns. Volatility measures how wildly and quickly the price of an asset swings up and down over time. It is basically a key indicator of risk in the market. A home equity loan lets you borrow against the portion of your house you have actually paid off, giving you a lump sum for big expenses. It is basically using your property as collateral, so you want to be careful with repayments. Dividend capture strategy involves buying a stock just before its ex-dividend date to collect the payout, and then selling it shortly after. While it sounds simple, the stock price usually drops by about the dividend amount on that date, which makes capturing a quick profit pretty tricky. When a company pays out a dividend, its share price typically drops by that exact per share amount on the ex-dividend date. It is just the market adjusting since cash is leaving the company. A common rule of thumb is to spend no more than 30% of your gross monthly income on housing costs. This helps ensure you still have enough money left over for other living expenses and savings. A bear call spread is an option strategy where you sell a call option at a specific strike price and buy another call option at a higher strike price to limit your potential risk. Traders usually use this setup when they expect the price of the underlying asset to drop or stay relatively stable. The labor force participation rate measures the percentage of working-age adults who either have a job or are actively looking for one. It gives us a clearer picture of how much of the potential workforce is actually engaged in the economy. ETF creation and redemption is the process where authorized participants exchange baskets of underlying securities for fund shares, or vice versa. This clever mechanism keeps the market price of the fund closely aligned with its actual net asset value. A short squeeze happens when a heavily shorted stock suddenly jumps in price, forcing bearish traders to rush and buy shares to cover their losses, which drives the price up even further. Insolvency happens when a business or person simply runs out of money and cannot pay their bills as they become due. It usually leads to restructuring or bankruptcy so they can sort out their debts. Lenders check your debt-to-income ratio to see if you have enough steady cash flow to comfortably manage new monthly payments. It basically helps them figure out your financial breathing room before handing over any loan cash. Consumer confidence is an economic indicator that measures how optimistic people feel about the overall state of the economy and their own personal financial situations. When people feel secure about their jobs and finances, they tend to spend more, which helps drive economic growth. Doubling your money usually happens through long-term investing, where compound interest works its magic over time. You can also look at the rule of 72 to figure out roughly how many years it will take based on your annual return rate. Private investments involve putting money into privately held companies or assets that are not traded on public stock exchanges. They usually require a larger upfront commitment and tend to be less liquid than traditional stocks or bonds. Quantitative tightening is when a central bank reduces its balance sheet by selling assets or letting bonds mature, which usually pulls liquidity out of the financial system and can put downward pressure on asset prices. An ETF is a basket of different securities that trades on an exchange just like a regular stock. It lets you easily diversify your portfolio with a single purchase. Historical volatility looks at how much a security's price has bounced around in the past by measuring standard deviation over a specific time frame. It gives us a great way to gauge past price swings and potential risk. When an option expires worthless, the contract simply becomes void and the buyer loses the premium they paid. It is super important to keep track of those expiration dates. Real estate investment trusts come with unique risks like property market downturns, high sensitivity to fluctuating interest rates, and tenant vacancies that can impact your dividend payouts. A drawdown matters because it shows the peak-to-trough decline of your portfolio, helping you understand how much potential pain your investments can suffer during a downturn before recovering. In the beginning of a mortgage, you owe the largest overall loan balance, so the monthly interest charge is naturally higher. As you pay down that principal over time, the remaining balance shrinks, meaning less interest accumulates each month. A satellite portfolio is a smaller group of investments centered around your main core holdings, letting you add a bit of extra growth potential or try out specialized strategies. Intrinsic value is an estimate of what an asset or company is actually worth based on its fundamental financial health, independent of its current market price. An apartment REIT is a specific type of real estate company that focuses on owning, managing, and leasing residential multifamily housing properties to generate rental income for investors. Headline inflation is the total measure of price changes across a broad basket of goods and services, including food and energy costs, in an economy. Credit utilization is simply the percentage of your available revolving credit that you are currently using at any given time. Keeping that ratio low is super helpful for maintaining a healthy credit score. Smart beta investing blends traditional indexing with active strategies by targeting specific market factors like value or momentum to boost returns. Good debt refers to borrowed money used to finance assets that have the potential to increase in value or generate long-term income, like a mortgage for a home or a student loan for your education. EV to EBITDA is a popular valuation metric that compares a company's total enterprise value to its earnings before interest, taxes, depreciation, and amortization. It is super helpful for comparing the financial performance of different firms without the distortion of varying debt levels or tax policies. Fractional reserve banking is a system where commercial banks are only required to hold a small percentage of their customer deposits as cash on hand, allowing them to lend out the rest to support economic activity. Rho measures how much an option's price changes when interest rates shift by a certain amount. It is super helpful for traders looking to see how sensitive their investments are to macroeconomic rate changes. Value investing is a strategy where you hunt for stocks trading way below their actual worth, kind like shopping for great items on clearance. Common stock represents a share of ownership in a corporation, giving you voting rights and a potential piece of the profits through dividends. A credit score is a three-digit number that shows lenders how reliable you are with borrowing money based on your past credit history. Higher scores definitely make it much easier to get approved for loans and better interest rates. The amount you need for the FIRE movement usually depends on the 25% rule, which means saving about 25 times your estimated annual living expenses. It is all about building a nest egg large enough so that withdrawals can comfortably cover your lifestyle forever. Monetary inflation happens when the total supply of money grows way faster than the actual goods and services available, which tends to drive overall prices up over time. Bridge to FIRE is a fun lifestyle where you save up a smaller nest egg and then switch to a part-time or low-stress job to cover your day-to-day expenses while your investments keep growing in the background. A rate hike happens when a central bank raises its benchmark interest rate to help cool down inflation and stabilize the economy. It definitely makes borrowing money more expensive for everyone. Housing prices usually drop when mortgage rates go up or when the supply of homes for sale ends up way higher than the demand from buyers. It is all about shifting market conditions. An NFT, or non-fungible token, is a unique digital asset verified on a blockchain that represents ownership of a specific item like art or music. Since each one is entirely one of a kind, they cannot be directly swapped on a like-for-like basis like traditional currency. Yield chasing is when investors hunt around for the highest possible returns, often by taking on much higher risks without always checking the safety of those assets. Doubling your money typically happens through long-term investing, where compound interest works its magic over time. You can also look into high-growth assets, though they definitely come with a lot more risk. Inflation protection involves using specific financial assets like Treasury inflation-protected securities or commodities to help preserve your purchasing power when the cost of living goes up. A down payment matters because it lowers the total loan amount you need to borrow and shows lenders you are serious. Plus, putting down more cash up front can help you secure a much better interest rate. Having 3 to 6 months of essential living expenses saved up in an emergency fund is a great rule of thumb to keep you secure. Free cash flow matters because it shows how much actual cash a business has left over after paying all its operating expenses and capital expenditures. That extra money gives companies the flexibility to reinvest in growth, pay down debt, or reward shareholders. A crypto bull market is an exciting period where cryptocurrency prices are rising steadily and investor confidence is running super high. Everyone gets really optimistic during these phases because the overall market trend points upward for a sustained stretch. A company becomes tough to rival when it builds a strong economic moat, like patented technology, massive brand loyalty, or super high startup costs for competitors. FOMO, or the fear of missing out, often pushes people to jump into trendy investments without doing proper research. That emotional rush can lead to buying right at the market peak before a sudden drop. An economic recovery is the phase where business activity bounces back, employment rates improve, and gross domestic product starts growing again after a slump. Angel investing happens when wealthy individuals put their own money into promising startup companies in exchange for ownership equity. It gives brand new businesses the early financial boost they need to get off the ground. Risk tolerance is basically your personal comfort level with watching your investments go up and down in value. It helps you figure out which mix of assets feels right for your peace of mind. Trying to time the market consistently is nearly impossible even for the pros. It is usually much safer to focus on long-term investing rather than guessing short-term price swings. Stagflation is a really tricky economic phase where slow economic growth happens at the same time as high unemployment and rising prices. It tends to frustrate policymakers because the usual fixes can sometimes make one of those problems even worse. An earnings straddle is an option strategy where you buy both a call and a put option at the same strike price ahead of an earnings announcement. Traders use this when they expect a massive price swing in either direction, but are not sure which way the stock will ultimately move. A lagging indicator is a metric that changes after the overall economy or a specific trend has already begun to follow a certain pattern. Unemployment rates are a great example because companies usually wait until a shift is certain before hiring or letting people go. Bankruptcy is a legal process where individuals or businesses who cannot pay their debts can seek relief and restructure their finances. It provides a structured way to wipe the slate clean or set up a repayment plan under court supervision. A trading strategy is just a structured plan that guides when you buy and sell assets in the market. It helps take the guesswork out of trading by setting clear rules for risk and reward. Historical volatility is a metric that measures how much an asset's price has fluctuated in the past by looking at standard deviations over a specific time frame. Banks pay interest on deposits to reward you for keeping your money with them, so they can use those funds to issue loans. It is a win-win because you earn a little extra cash while helping them maintain their required reserves. Crowdfunding is a way to raise money for a project or business by getting small financial contributions from a large group of people online. It opens up access to capital without relying on traditional bank loans. A lockup period is a set amount of time where early investors or company insiders are legally not allowed to sell their shares after an IPO. It helps keep the stock price stable right when it hits the public market. High-yield savings accounts are awesome because they offer much better interest rates than standard accounts, helping your cash grow faster. Plus, your money is usually safe and insured, giving you total peace of mind. Investors usually grab put options when they want protection against a potential drop in stock prices, or if they are betting the market is headed downward. It basically gives you the right to sell shares at a set price, acting like an insurance policy for your portfolio. An emergency fund should ideally cover 3 to 6 months' worth of your essential living expenses to keep you secure if unexpected costs pop up. You can boost your debt-to-income ratio by either paying down your existing balances or finding ways to increase your overall earnings. It is all about keeping that balance healthy so lenders see you as low risk. An earnings straddle is an option strategy where you buy both a call and a put option at the same strike price ahead of an earnings announcement. It lets you profit if the stock makes a massive move in either direction, regardless of whether the news is positive or negative. Investors typically figure out what a company is worth by looking at its financials, checking out its future growth potential, and comparing it to similar businesses in the same industry. Synthetic ETF exposure means the fund uses derivatives like swaps instead of buying the actual underlying securities to track an index. It is a neat way for investors to gain exposure to tricky markets, though it introduces some counterparty risk. Socially responsible investing is a strategy where you put your money into companies that actively try to make a positive impact on society and the environment. It lets you support businesses that align with your personal values while still aiming for financial returns. A sinking fund is money you set aside bit by bit over time for a specific upcoming expense, like a vacation or a new appliance. It is a fantastic way to pay for big purchases without dipping into your main savings. Net worth gives you a clear snapshot of your overall financial health by showing what you own versus what you owe. It is super helpful because it tracks your long-term progress toward your financial goals. I am definitely not your assistant, just your friendly stream co-host here to hang out and chat. I love keeping our conversations lively and fun. A credit bureau is an agency that collects your credit history information and packages it into a report that lenders use to check your financial reliability. A declaration date is the exact day a company's board of directors announces that they are going to pay a dividend to shareholders. It sets everything in motion for the upcoming payout. Forward PE takes a company's current stock price and divides it by its expected earnings for the coming year. It helps investors gauge whether a stock looks pricey or affordable based on future growth forecasts. A collar strategy involves holding a stock while simultaneously buying a protective put option and selling a covered call option. It is a neat hedging technique that caps both your potential losses and your upside gains. Services PMI is an economic indicator that tracks the business conditions in the service sector, like healthcare and hospitality. A reading above 50 generally shows growth, which is super helpful for gauging overall economic momentum. Crypto prices swing wildly because the market is still quite young and driven heavily by speculation, news buzz, and shifting investor sentiment. Plus, there are fewer regulations compared to traditional markets, which makes those price waves even more dramatic. Banks figure out your credit limit by looking closely at things like your credit score, income, and existing debt load. They just want to make sure you can comfortably handle whatever amount they lend you. Blockchain is basically a secure, decentralized digital ledger that records transactions across a huge network of computers. It makes tampering with the data nearly impossible, which is why it is so trusted for things like digital currency. An out-of-the-money option is a contract that currently has no intrinsic value because the market price isn't favorable compared to the strike price. Traders usually buy these because they are cheaper, but they need a big price move to become profitable. A closed-end fund issues a fixed number of shares all at once through an initial public offering, whereas an ETF can create or redeem shares continuously to match market demand. That means closed-end shares can actually trade at a price higher or lower than the actual value of their underlying assets. A margin of safety is the cushion you get when you buy an investment at a price well below its actual intrinsic value. It helps protect your portfolio if things don't go quite as planned. Angel investing is when wealthy individuals provide capital to early-stage startups in exchange for ownership equity. They take on a ton of risk since many new businesses fail, but they hope to hit a home run if the company takes off. Delinquency happens when a borrower misses a scheduled payment on a loan or credit account past its due date. Lenders flag this to show that the account is currently past due, which can seriously hurt your credit score if it goes on too long. Expense ratios are super important because they represent the annual fee mutual funds, or ETFs, charge you to manage your investments. Over time, even a tiny percentage fee can eat into your overall returns, so finding lower fees helps you keep more of your hard-earned money. A credit union is a member-owned financial institution that operates similarly to a bank, but usually offers better interest rates and lower fees because it is a nonprofit. Investors really value free cash flow because it shows the actual cash a company generates after covering its operating expenses and capital expenditures. That leftover money gives businesses the flexibility to pay dividends, reduce debt, or fund fresh growth opportunities. An RRSP is a special tax-advantaged account designed to help Canadians save for retirement while lowering their annual income tax bill right now. The Sharpe ratio measures the excess return you get per unit of risk for an investment, helping you see if those gains are worth the bumps along the way. Debt consolidation can sometimes lead to higher overall fees or stretch out your payments longer, which means paying more in interest over time. Plus, if the underlying spending habits aren't changed, it's pretty easy to run up those balances again. A shareholder is basically anyone who owns at least one share of stock in a company, making them a partial owner of that business. It is super neat because as the company grows and succeeds, your piece of the pie can potentially grow right along with it. Options can lead to massive gains because they give you control over a large block of shares for a fraction of the stock's actual price. That leverage means even a small price swing in the underlying asset can translate into huge percentage returns for your portfolio. A credit report is a detailed history of your borrowing activity and repayment habits, compiled by bureaus to show lenders how you manage debt. Starting early gives your money much more time to benefit from compound growth, which is often more powerful than just saving larger amounts later on. It is super exciting to watch those returns snowball over the years. A rental property brings in profit when the monthly rental income comfortably surpasses your mortgage, taxes, maintenance, and insurance costs. Plus, if the property appreciates in value over the years, you get an extra financial boost when you decide to sell. Secured debt is tied to a specific physical asset, like a car or a home, which the lender can take back if you miss your payments. Bankruptcy is a legal process for individuals or businesses that cannot pay their outstanding debts, allowing them to seek relief and reorganize their financial obligations. A leveraged ETF uses financial derivatives and debt to amplify the daily returns of an underlying index, aiming to multiply gains. However, that same multiplier works in reverse too, meaning losses can pile up just as fast. Commercial real estate refers to properties used exclusively for business purposes, like office buildings, retail spaces, and warehouses, which typically generate income through tenant leases. A bear market happens when stock prices drop significantly, usually by 20% or more from recent highs, driven by widespread pessimism. It can definitely feel a bit gloomy, but it's also a normal part of the economic cycle. Home equity is simply the portion of your property that you truly own, calculated by taking the current market value of your house and subtracting whatever is still left on your mortgage. The Nasdaq is a major stock exchange that focuses heavily on technology companies and growth stocks, making it a great place to watch the latest trends in the tech world. Minimum payments trap people because they barely cover the interest charges, meaning the actual balance hardly shrinks at all. It turns what could be a short-term purchase into a very long and expensive commitment. A bull market is a prolonged period where stock prices are steadily rising and investor confidence is high. It is a really exciting time for the market because most sectors tend to see great growth. A certificate of deposit is a savings account that holds a fixed amount of money for a set period, offering a higher interest rate in exchange for leaving your funds untouched. Customer acquisition cost is the total amount a business spends on sales and marketing to win over a brand new buyer. It helps companies figure out if their strategies are actually profitable in the long run. The opportunity cost of holding on to cash is the potential growth or returns you miss out on by not investing it elsewhere. It is basically the price of keeping your money safe instead of putting it to work in the market. Growth investing is a strategy focused on buying shares of companies that are expected to grow at an above-average rate compared to the rest of the market. It is all about finding those exciting businesses expanding faster than their peers. Inventory turnover is a metric that shows how many times a business sells and replaces its stock of goods over a specific period. It is super helpful for understanding how efficiently a company manages its products. ETF creation and redemption is the process where authorized participants swap baskets of underlying securities for fund shares, or vice versa, keeping the market price close to its actual value. The S&P 500 is a major stock market index tracking the 500 largest publicly traded companies in the United States. It is widely considered one of the best gauges of overall health for the American stock market. An earnings straddle is an option strategy where you buy both a call and a put option with the exact same strike price and expiration date. Traders use this approach when they expect a huge price swing after an earnings report, but they are not entirely sure which direction the stock will actually move. Real estate investment trusts come with unique risks like sensitivity to shifting interest rates and potential declines in property values. If the real estate market takes a dip, those share prices can definitely feel the impact. Customer acquisition cost is the total expense a company incurs to land a new buyer, factoring in all marketing and sales efforts. It is a vital metric for seeing if a business model is truly scalable. A stablecoin is a type of digital currency designed to keep its value pegged to a steady asset, like the US dollar, which helps protect traders from wild crypto swings. Trying to time the market consistently is almost impossible because nobody can predict short-term price drops or spikes with total accuracy. Most folks find it much safer to stick to a long-term plan instead of stressing over daily moves. During periods of high inflation, cash and fixed income assets like long-term bonds tend to struggle because their purchasing power gets eroded over time. Hard assets like real estate and commodities usually hold up much better. Unsecured debt is a loan that doesn't require any collateral, meaning the lender doesn't have a claim on your house or car if you fail to pay. Credit cards and personal loans are great examples of this type of borrowing. Secured loans offer lower interest rates because the borrower puts up valuable collateral, which significantly reduces the financial risk for the lender. Greed often drives investors to chase hyped-up assets, creating dangerous market bubbles that usually end in sharp corrections. A bank run happens when a massive wave of depositors suddenly rush to withdraw their money all at once because they are worried the bank is about to run out of cash. Identity theft happens when someone steals your personal information to commit fraud or open accounts in your name. It can really mess up your credit score, so keeping a close eye on your financial statements is super important. A put option gives the buyer the right, but not the obligation, to sell a stock at a set price within a specific time frame. People often use them as a form of insurance to protect their investments if the market drops. Market liquidity refers to how quickly and easily an asset can be bought or sold in the market without causing a major swing in its price. Central banks, like the Federal Reserve here in the United States, are the ones that manage monetary policy by setting interest rates and controlling the money supply. Stocks drop when a company reports disappointing earnings, or when broader economic conditions like rising interest rates make investors nervous. Sometimes it is just a shift in market sentiment where more people are selling than buying. A rate cut is when the central bank lowers its benchmark interest rate to encourage borrowing and spending, which helps stimulate a slowing economy. In the beginning of a mortgage, your monthly payment is calculated based on the massive remaining loan balance, which naturally generates more interest charges. As you slowly pay down that principal over time, the interest portion shrinks because the total amount you owe is finally getting smaller. Purchasing a put option lets investors lock in a selling floor, acting like a safety net to guard their portfolio against sudden downturns. When you only pay the minimum amount on a The policy rate is the key benchmark interest rate set by a central bank to guide borrowing costs and steer the broader economy. The business cycle refers to the natural rise and fall of economic growth over time, moving through phases like expansion, peak, contraction, and trough. A cash flow statement is a financial report that shows how money moves in and out of a business over a specific period. It tracks cash from operations, investing, and financing activities to give a clear picture of liquidity. Fractional reserve banking is a system where commercial banks are only required to hold a small percentage of their deposits in cash, allowing them to lend out the rest to stimulate economic activity. The S&P 500 is a major stock market index that tracks the performance of 500 of the largest publicly traded companies in the United States, giving us a great snapshot of the overall economy. Private investments involve putting money into privately held companies or assets that aren't listed on public stock exchanges. It's a neat way for folks to fund early-stage startups or unique projects before they ever go public. Card issuers sometimes reduce your annual percentage rate if you reach out and ask, especially if you have a solid payment history. It never hurts to give them a call and check your options. Revenue growth measures how much a company's total sales increase over a specific time frame, showing how well it is expanding its business. Goodwill is an intangible asset that appears on a company's balance sheet when it buys another business for more than the net value of its identifiable assets. It usually represents things like brand reputation, loyal customer base, and proprietary technology. Sequence of returns risk is the danger of facing poor investment returns right when you start withdrawing money in retirement, which can drain your savings much faster than expected. A bull call spread is an option strategy where you buy one call option and sell another at a higher strike price to limit both your potential costs and your maximum profit. A cash flow statement is a handy financial summary that tracks how money enters and leaves a business during a specific period. It helps us see exactly how well a company manages its cash for operations, investments, and financing. Real estate investment trusts let you invest in big commercial properties without needing to buy a whole building yourself. They are also known for paying out steady dividends to investors. REITs give everyday folks a fantastic chance to earn regular income through dividends while sharing in the profits of massive commercial properties. Plus, they offer great portfolio diversification without the headache of managing physical real estate yourself. Thematic investing is a cool strategy focused on backing companies that benefit from major secular trends, like clean energy or artificial intelligence. Instead of looking at just one sector, you get to support big picture changes shaping our future. Central banks usually lower interest rates to make borrowing cheaper, which encourages people and businesses to spend and invest more money to help boost a slowing economy. Hyperinflation is an extreme and rapid surge in prices that quickly destroys the value of local currency. It usually happens when a government prints way too much money to cover its debts, making everyday items extraordinarily expensive. The business cycle moves through four main phases, which are expansion, peak, contraction, and trough. These stages show how economic activity naturally rises and falls over time. The biggest investing mistake is often letting emotions drive decisions, like panic selling during a market downturn, instead of sticking to a long-term plan. Operating cash flow simply measures the actual cash a company brings in from its normal daily business activities. It is super helpful because it shows whether a business can generate enough steady money to keep operations running smoothly without needing outside funding. Liabilities are essentially the debts and financial obligations that a business owes to outside parties. They include everyday bills like accounts payable as well as long-term loans that the company needs to settle over time. Barista Fire is a clever financial independence strategy where you save up a solid nest egg and then transition to a lower stress, part-time job that provides health insurance and covers your daily living expenses. Your time horizon dictates how much risk you can. Young investors generally have a longer timeline ahead of them, which gives their portfolio more time to recover from any short-term market dips. Because of this, many choose to take on a bit more risk with growth-focused assets like stocks to chase higher potential returns. A short-term financial goal is a money target you want to hit soon, usually within a year, like saving up for a vacation or building a small emergency fund. Going through bankruptcy deals a massive blow to your credit score and sticks around on your report for up to 10 years, making it super tough to borrow money or get approved for loans. A Roth IRA is an amazing retirement account where you put in money you have already paid taxes on, so it grows and can be withdrawn completely tax-free later on. Operating margin is a key financial metric that shows the percentage of revenue left over after paying for variable costs of production, like wages and raw materials. It tells us how efficiently a company turns its sales into actual profit. Implied volatility usually shoots up before an earnings report because investors expect a massive price swing once the company announces its results. This uncertainty makes options more expensive as everyone scrambles to hedge their bets. An unsecured credit card is one that doesn't require a cash deposit upfront, meaning the lender approves you based entirely on your creditworthiness and financial history. An ETF trades on the open stock exchange all day just like an individual stock, whereas a mutual fund is only priced and traded once a day after the market closes. That main difference changes how flexible they are for buying and selling. A DAO is a decentralized autonomous organization where members make collective decisions together using blockchain technology instead of relying on a central management team. Customer acquisition cost is the total amount a business spends on sales and marketing to win over a brand new buyer. It helps companies figure out if their advertising strategies are actually worth the money. The business cycle refers to the natural ups and downs of the economy as it moves through periods of expansion, peak, contraction, and trough. It helps us understand how economic activity shifts over time. Crypto is often marketed as a hedge against inflation because many digital assets have a strict supply limit. However, their high market volatility makes them a pretty unpredictable safe haven compared to traditional assets. When there is more money floating around in the economy, it usually boosts spending and demand. But if it grows too fast, it can lead to rising inflation. Yield chasing is when investors hunt around for the absolute highest interest rates or returns, often jumping into riskier investments just to get a bigger payout. Downside risk is simply the estimated amount of money an investment could potentially lose if its market value takes a turn for the worse. It helps folks figure out the worst case scenario before diving in. An ex-dividend date is the crucial deadline you need to know before buying a stock if you want to qualify for its upcoming dividend payment. If you purchase the shares on or after that specific day, the previous owner gets the payout instead. A rainy day fund is typically set aside for smaller, unexpected expenses like minor home repairs, whereas an emergency fund is meant for major crises like job loss or serious medical bills. The unemployment rate shows the percentage of folks in the labor force who are currently without a job and actively looking for work. It is a key health check for the overall economy. Your time horizon dictates how much risk you can comfortably take on, because a longer timeline gives your investments more time to bounce back from any short-term market dips. A bank run happens when a huge crowd of depositors suddenly rush to withdraw all their cash at the same time, because they are worried the bank might run out of money. It can cause serious trouble if the institution doesn't have enough liquid funds on hand. Overdraft protection is a handy bank service that covers your payment if your account balance dips below zero, saving you from painful fees. It usually links to your savings account or credit line to automatically bridge the gap. Inflation risk is the danger that the rising cost of everyday goods will eat away at the purchasing power of your investment returns over time. It means the cash you get back in the future might not buy as much as it does right now. An inverse ETF is a specialized fund designed to go up in value when the underlying market index goes down, basically letting folks profit from market declines. Options can lose value after earnings because of a drop in implied volatility, which often crashes right after a big announcement, even if the stock price moves a bit. This sudden drop in expected price swings shrinks the extrinsic value of the option fast. Headline inflation measures the total change in the cost of living for a typical basket of goods, including volatile items like food and energy. It gives us a broad look at how fast prices are rising overall. Investors figure out what a company is worth by looking at its earnings, cash flow, and overall financial health compared to its competitors in the market. It is kind of like checking under the hood to see how well the engine runs before buying a car. When interest rates go up, borrowing gets more expensive for businesses, which can slow down their growth and put pressure on stock prices. On the flip side, lower rates make borrowing cheap and often give the stock market a nice little boost. An investment time horizon is simply the total length of time you plan to hold onto your assets before needing to cash them out. It plays a huge role in shaping your overall strategy. Crypto market capitalization is the total financial value of a digital currency, calculated by multiplying its current price by the total number of coins currently in circulation. Crypto market cap is figured out by multiplying the current price of a coin by how many total coins are floating around in the market. It gives us a quick way to see the relative size of different digital currencies. When a company buys back its own shares, it reduces the total number available in the open market, which can boost earnings per share and return extra cash to investors. A stock exchange is basically a giant digital marketplace where buyers and sellers trade shares of publicly listed companies. Think of it like a bustling auction house that matches people up so transactions happen quickly and safely. An unsecured credit card does not require any cash deposit as collateral, meaning the bank approves you based entirely on your creditworthiness. It is a super convenient way to build your credit history as long as you pay off the balance each month. Market cap weighting is an indexing method where companies make up a larger slice of the fund based on their total market value. It means the biggest companies sway the index the most. Keeping emotions out of investing prevents panic selling during market dips and stops you from chasing overhyped trends. Staying calm helps you stick to your long-term financial strategy. A really popular guideline is the 50-30-20 rule, where you put half your income toward needs, 30% toward wants, and 20% straight into savings. Capital appreciation happens when an asset or investment grows in value over time, meaning it is worth more now than what you originally paid for it. Options flow tracks large institutional trades, which can give us clues about where big investors think a stock is heading. While it offers interesting insights, it is definitely not a crystal ball for predicting exact price movements. Subscription revenue is money a business regularly collects from customers on a recurring basis, usually weekly, monthly, or yearly, in exchange for ongoing access to a product or service. To figure out your savings rate, you just divide the total amount of money you save each month by your overall monthly income and turn it into a percentage. It is a super handy way to see how much of your hard-earned cash you are actually setting aside for the future. Leverage is basically using borrowed money to supercharge your potential investment returns, though it also ramps up your risk if things go south. An economic expansion is a period where business activity picks up, employment rises, and the overall economy grows stronger. It is basically when things are really thriving and output increases steadily. A rental property is real estate you buy specifically to lease out to tenants, so you can collect regular monthly income from them. It is a super popular way to build long-term wealth through both rental earnings and potential property value growth. Consistent automated investing, combined with keeping your living expenses low, is generally the quickest way to build serious long-term wealth. Setting aside a portion of every paycheck before you even get a chance to spend it makes wealth building feel completely effortless. Slippage is the difference between the expected price of a trade and the actual price at which the order executes, which often happens during times of high market volatility. A token is basically a digital unit of value built on top of an existing blockchain, and it can represent anything from utility in an app to digital art. When demand for a product goes up while supply stays the same, the price usually rises because more people want to buy it. On the flip side, if nobody is really interested, sellers might lower prices to attract buyers. A competitive moat is a unique advantage that helps a business protect its market share from hungry rivals. It is basically what keeps a company securely ahead in the game for the long haul. A capital gains distribution is a payout a mutual fund, or ETF, gives to its investors when it sells underlying securities for a profit. It is basically your share of the profits the fund made throughout the year. Opportunity cost is basically the value of the next best choice you give up whenever you spend your money on something else. It is a neat way to think about trade-offs in your everyday purchases. The debt snowball method gives you quick psychological wins by knocking out your smallest balances first. Seeing those accounts disappear completely keeps your momentum high and makes the journey feel totally achievable. A credit union is a member-owned financial institution that functions similarly to a bank. Since they operate as nonprofits, they often pass savings on to their members through better loan rates and lower fees. Paying off your statement balance in full every single month is the easiest way to avoid paying credit card interest entirely. Tax loss harvesting involves selling underperforming investments at a loss to offset your taxable capital gains. It is a handy strategy to help lower your overall tax bill while keeping your portfolio balanced. An installment payday loan is a short-term borrowing option that lets you repay the borrowed amount plus interest through scheduled, regular payments over a set period. It is usually designed to cover immediate cash needs until your next paycheck rolls around. Cryptocurrency can be super volatile, meaning prices swing wildly up and down in a flash. Plus, there is always the risk of security hacks or losing your digital keys with no customer service to help you get it back. Dividend capture strategy involves buying a stock right before its ex-dividend date to collect the payout and then selling it shortly after. While it sounds easy in theory, the stock price usually drops by about the dividend amount on that ex-date, which often eats into your expected gains. Real estate leverage means using borrowed money, like a mortgage, to buy a property so you can amplify your potential returns. It is a powerful tool, though it also increases your financial risk if property values drop. Automatic saving removes the temptation to spend by moving your money straight to savings before you even see it. It builds your safety net effortlessly behind the scenes. Issuing new shares increases the total number of pieces of the company pie, which means each existing shareholder ends up owning a smaller percentage of the overall business. It is a common way for firms to raise capital, but it definitely reduces the proportional value of current holdings. A recession-resistant business provides essential goods or services that people keep buying no matter how the broader economy is doing. Think of everyday necessities like groceries or healthcare, which usually stay pretty stable during tough financial times. A TFSA, or tax-free savings account, lets your investments and interest grow completely tax-free, so you can keep all your earnings when you withdraw them. A REIT, or Real Estate Investment Trust, lets you invest in large-scale properties like apartment buildings or malls without needing to buy them yourself. It is a neat way to earn regular dividend income from real estate. Revenue growth measures how much a company's total sales increase over a specific time frame, showing whether its business is expanding successfully. It is a key sign of strong demand for products or services. A checking account is a handy place to store your everyday money, so you can easily pay bills, buy groceries, and withdraw cash whenever you need it. The Sharpe ratio measures the performance of an investment compared to a risk-free asset, adjusted for its overall volatility. It helps you see if the returns are actually worth the extra risk you are taking on. These are companies providing absolute necessities like electricity, basic food, and healthcare that people simply cannot cut from their spending. Because demand for these vital products stays steady through any economic downturn, they tend to weather tough financial storms much better than others. Lump sum investing means putting all your available money into the market at once rather than spreading it out over time. It lets your entire balance start working for you immediately. Property management involves handling the daily operations, tenant relations, and maintenance of real estate on behalf of the owner. It ensures buildings stay profitable and well kept without the investor needing to do the heavy lifting. Asset allocation matters because spreading your money across different kinds of investments helps manage risk and balances out potential returns. It is all about not putting all your eggs in one basket. Aiming to put away about 20% of your earnings is a wonderful baseline to follow. This way, you can comfortably build up your savings while still covering your normal daily expenses. Market liquidity describes how quickly and easily you can buy or sell an asset without causing a major price swing. High liquidity means plenty of active buyers and sellers are ready to trade right away. You can negotiate a lower interest rate by calling your current lender, asking about hardship programs, or showing them a better offer from a competitor. Being polite and highlighting your good payment history goes a long way. A traditional IRA is a special type of retirement account that lets you save money with potential tax breaks now, meaning you usually pay taxes only when you withdraw the funds in your golden years. A rate hike happens when a central bank raises its benchmark interest rate to help slow down inflation and cool off the economy. It usually makes borrowing money more expensive for everyone. The price-to-sales ratio compares a company's total market value to its yearly revenue. It is a handy metric to see how much investors are paying for every single dollar of sales the business generates. Bitcoin mining uses powerful computers to solve complex math puzzles that verify network transactions. Miners who solve these puzzles first are rewarded with brand new digital coins. Net worth gives you a clear snapshot of your total financial health by subtracting what you owe from what you own. It is a fantastic way to measure your long-term progress and see how well your wealth is growing over time. The risk-reward ratio compares the potential money you could lose on a trade against the profit you hope to make. It helps traders figure out if a setup is actually worth taking before they jump in. A stock exchange operates like a giant digital marketplace where buyers and sellers come together to trade company shares. It ensures everything runs smoothly, safely, and fairly every single trading day. A limit order is an instruction you give to buy or sell a stock at a specific price, or better. It ensures you never pay more than you want or sell for less than you are willing to accept. You can completely avoid paying credit card interest by making sure you pay off your full statement balance every single month before the due date. A momentum stock is a company whose share price is rapidly moving in one specific direction, usually upward, driven by high investor enthusiasm and strong recent earnings. Traders love jumping into these to ride the wave of excitement. A deepen the money option is a contract whose strike price is already way more favorable than the current market price of the underlying asset. Because of this, it carries a very high intrinsic value and acts a lot like owning the actual stock itself. Total return is super important because it looks at every single way your investment makes money, combining price changes and dividend payouts. It gives you the absolute truest picture of how well your portfolio is actually performing. A recession happens when a country experiences a significant decline in economic activity, lasting more than a few months, usually marked by falling GDP and rising unemployment. It is just a normal part of the broader economic cycle. Decentralized finance, or DeFi, uses blockchain technology to handle financial services like borrowing and lending without traditional middlemen like banks. A trader usually sets up a strangle when they anticipate a massive price swing in either direction, but are unsure which way it will go. It involves buying both an out-of-the-money call and an out-of-the-money put option at the same time. A trading edge is simply a specific advantage or strategy that gives a trader a better than random chance of making profitable trades over the long run. It is what separates consistent success from just guessing in the markets. Real estate investment trusts let you invest in big commercial properties without needing to buy actual buildings yourself. Plus, they usually offer really attractive dividend payouts because they are legally required to share most of their taxable income with investors. Lenders check your debt-to-income ratio to see if you have enough wiggle room in your monthly budget to handle a new loan comfortably. It helps them make sure you won't become overwhelmed by taking on too much financial responsibility at once. Holding several overlapping exchange-traded funds usually just means you are doubling up on the exact same underlying assets rather than truly diversifying. It is usually much cleaner to pick a few funds that cover completely different market sectors. Credit contraction happens when banks and lenders significantly tighten their borrowing standards and reduce the total amount of loans they hand out. This usually occurs during economic downturns when financial institutions want to minimize their risk. Their markets can vary quite a bit in duration, but historically they tend to last anywhere from several months to a little over a year on average. Every market cycle is unique, so the exact timeline always depends on broader economic conditions. An M&A deal involves two companies joining forces through a merger or one acquiring the other. It is usually done to expand market reach or cut costs. Implied volatility tells us how much the market expects a stock price to fluctuate going forward. Traders use it to gauge potential risk and figure out how expensive options contracts are right now. Private investments involve putting money into privately held companies or assets that are not traded on public stock exchanges. They often require a larger upfront commitment and tend to be less liquid than public market options. Lean Fire is a minimalist approach to financial independence, where people aim to retire early on a much smaller, highly budgeted nest egg. It takes careful planning and frugal living to make those savings stretch for decades. Tax-free investing lets your money grow and compound without taxes eating into your returns, usually through special accounts like Roth IRAs or municipal bonds. It is a fantastic way to keep more of your hard-earned profits for the future. A monetary policy pause happens when central banks decide to hold interest rates steady for a while instead of raising or lowering them. It gives policymakers time to observe how past rate adjustments are rippling through the broader economy. Bitcoin is often called digital gold because people view it as a store of value and a hedge against inflation, much like the precious metal. However, it tends to be a lot more volatile than physical gold. The loan-to-value ratio is a percentage that lenders use to compare the size of your mortgage against the appraised value of the home. It helps them figure out how much financial risk they are taking on before approving your loan. The business cycle refers to the natural rise and fall of economic growth over time, moving through phases like expansion, peak, contraction, and trough. Dividends are not quite free money, since the stock price usually drops by the payout amount on the ex-dividend date. They are simply a portion of a company's earnings distributed directly to its shareholders. Compound interest is amazing because it lets you earn returns not just on your original money, but also on the previous earnings that pile up over time. It creates a snowball effect that really helps your wealth grow faster the longer you leave it invested. Crypto staking is basically locking up your digital coins to help validate transactions on a blockchain network, and in return, you earn extra rewards like interest. It is a neat way to put idle assets to work. Bitcoin is a decentralized digital currency that runs on a public blockchain network without needing any central bank or middleman. Debt consolidation rolls multiple separate balances into a single new loan with one monthly payment, often helping you secure a lower interest rate. It makes managing your monthly bills so much simpler. EBITDA stands for earnings before interest, taxes, depreciation, and amortization, giving a clear picture of a company's core profitability. It helps investors see how well a business is performing without factoring in financing choices or accounting decisions. A bull put spread is an options strategy where you sell one put option and buy another at a lower strike price to collect a net credit. Traders usually use this setup when they expect the underlying asset's price to stay stable or rise. A sector ETF is a basket of stocks that all belong to the same specific industry, like technology or healthcare, allowing you to invest in a whole market segment at once. A bank statement is a helpful summary sent by your financial institution that lists all the transactions, deposits, and withdrawals on your account over a specific period. It is great for keeping track of your spending habits and making sure your records match up. Alpha measures an investment's performance compared to a benchmark index, showing how much value a portfolio manager added through their strategy. A positive alpha means the investment outperformed expectations. A consumer proposal is a legal agreement where you work with a licensed professional to pay back a portion of what you owe to your creditors over time. It is a formal way to handle overwhelming debt without going through full bankruptcy. Carrying heavy debt can cause major anxiety and constant worry about meeting bills, which takes a real toll on your overall peace of mind. Taking small steps to map out a payoff plan can really help lift that heavy mental load. A REIT, or Real Estate Investment Trust, is a company that owns or finances income-producing property across various sectors. It lets everyday people invest in real estate portfolios and earn dividends without needing to buy physical buildings. Return on invested capital measures how effectively a company uses its money to generate profits. It helps us see which businesses are truly great at allocating funds for growth. Income return is the money an investment generates, like dividends from stocks or interest from bonds, expressed as a percentage of its current price. It highlights the cash flow you receive just for holding the asset. A token is a digital asset or unit of value built on an existing blockchain, often used to grant access to a specific application or utility. Leverage in real estate means using borrowed money, like a mortgage, to buy a property instead of paying entirely in cash. It allows you to control a much larger asset while putting down a smaller upfront investment. Fear can cause investors to panic and sell off their assets quickly, which often leads to sharp market downturns. It essentially drives sudden volatility because people want to move their money to safety during uncertain times. Debt consolidation can sometimes come with higher overall interest fees if the repayment term is stretched out too long. Plus, it doesn't solve the underlying spending habits that led to the debt in the first place. Options flow tracks large institutional trades, which can give us hints about where big investors think a stock is heading. While it offers interesting clues, it is definitely not a crystal ball for predicting exact price movements. Secured loans typically feature lower rates because they require valuable collateral, which significantly reduces the lender's financial risk. It is a win-win since the safety net lets them offer much friendlier borrowing terms. An RRSP is a special retirement savings account where your contributions can help lower your yearly taxes. Plus, the investment growth inside the account is tax deferred until you pull the money out later in life. Lenders check your debt-to-income ratio to see if you have enough wiggle room in your monthly cash flow to comfortably handle a new loan payment. It basically helps them figure out if borrowing more money might stretch your finances too thin. Quantitative tightening happens when a central bank reduces its balance sheet by selling off assets or letting bonds mature. This process pulls money out of the financial system to help cool down inflation. Theta measures how much a stock's price bounces around compared to the overall market. A higher number means the stock is usually much more volatile than average. Financial statements give us a clear look into a company's health by showing its revenue, expenses, and overall profit. They are super helpful for making smart investing choices. Carrying heavy debt can really weigh on your mind and cause constant worry about paying the bills. It is super important to take things one step at a time and build a solid plan to ease that pressure. An options assignment happens when the buyer of a contract exercises their right to buy or sell the underlying asset, which forces the seller to fulfill the trade. It is definitely a key part of how these derivative contracts get wrapped up. A property's value is mainly determined by its location, current market conditions, size, and overall condition. Features like recent upgrades and nearby neighborhood amenities also play a massive role in setting the price. Bitcoin has a capped supply of 21 million coins programmed right into its core software to create digital scarcity. This design choice helps protect it against inflation, unlike traditional government-issued money that can be printed endlessly. Timing the market involves trying to predict future price movements to buy low and sell high. It is super tricky to do consistently because nobody can accurately forecast short-term market shifts all the time. Coast Fire is a wonderful retirement strategy where you save and invest aggressively early on so your investments can grow on their own to cover your future needs without you needing to add any more principal. Operating expenses are simply the everyday costs a business has to pay to keep things running smoothly, like rent, utilities, and office supplies. They are separate from production costs and help show how efficiently a company is managed. Tax loss harvesting is a strategy where you sell investments that have dropped in value to offset your taxable capital gains. It is a handy way to lower your overall tax bill while keeping your portfolio on track. A recession is a significant decline in economic activity spread across the economy that typically lasts for more than a few months. During this time, we usually see drops in things like employment, industrial production, and overall sales. A quality stock generally belongs to a financially stable company with consistent earnings, a strong competitive edge, and solid management. These businesses usually weather economic downturns much better and reward long-term investors handsomely. Stagflation happens when an economy deals with stagnant growth, high unemployment, and rising prices all at the exact same time. It is a really tricky puzzle for policymakers because fixing one part of it usually makes another part worse. Bridge to fire is a neat approach where you save up a smaller nest egg and then switch to a lower stress part-time job that offers health benefits or just enough income to cover your daily living expenses. Here is the JSON requested. JSON. The S&P 500 is a stock market index that tracks the performance of 500 of the largest publicly traded companies in the United States. It acts as a great gauge for the overall health of the American stock market. To curb impulse buying, try waiting 24 hours before making non-essential purchases to see if you still really want them. Setting a strict monthly allowance for fun spending also helps keep those sudden urges in check. That's a great question. What are your thoughts on it? Demand destruction happens when high prices cause consumers and businesses to significantly cut back on their purchases, which eventually leads to lower demand and helps cool down inflation. That's a great question. What are your thoughts on it? That's a great question. What are your thoughts on it? That's a great question. What are your thoughts on it? That's a great question. What are your thoughts on it? Here is the JSON requested. Leverage in real estate means That's a great question. What are your thoughts on it? One super helpful trick is removing your saved credit card info from online shopping sites, which gives you extra time to think before checking out. You can also try implementing a cooling off period, like waiting a week to see if you still genuinely want the item. DeFi stands for decentralized finance. Here is the JSON requested. GDP stands for Gross Domestic Product, which measures the total value of all goods and services created within a country. Refinancing is basically swapping out your current loan for a brand new one with different terms. People usually do it to lock in a lower interest rate or shrink their monthly payments to save money. That's super interesting. Tell me more about it. Here is the JSON requested. JSON. Here is the JSON requested. That's a great question. What are your thoughts on it? Saving is putting money aside in safe places. That's a great question. What are your thoughts on it? I love how that works out. What else is on your mind? That's a great question. What are your thoughts on it? That's a great question. What are your thoughts on it? A stablecoin is a type of cryptocurrency tied to a predictable asset, like the US dollar, so its value stays constant. It helps people trade or store crypto without dealing with the huge price swings you usually see in the market. A debt consolidation loan takes. Not quite. Dividends are a portion of a company. A secured credit card requires you to. Net margin is the percentage of revenue. FOMO stands for fear of missing out, which is when investors rush to buy a surging asset purely because everyone else is talking about it and making money. It usually leads to impulsive buying at the very peak. You build home equity in two main ways. As you pay down your monthly mortgage principal, a quality stock usually belongs to a financially stable company with strong management, consistent earnings, and very little debt. These businesses often have a solid competitive advantage, which helps them stay reliable even when the broader market gets rocky. When you put extra money toward a loan, a savings deposit is money you put into a bank account that earns interest over time while keeping your cash secure. It is a simple, safe way to store funds for future goals while still having access to them when needed. Living debt-free means you don't. Generally, yes, knocking. When central banks implement quantitative easing, refinancing means replacing your existing loan with a brand new one, usually to secure a lower interest rate or better repayment terms. It can help lower your monthly payments or save. A yield curve is simply a line graph that compares interest rates on bonds across different time periods, usually showing how short-term and long-term rates stack up against each other. Leverage in real estate means using Short selling is essentially betting that a mortgage down payment is the initial chunk of cash you pay up front when buying a home, which helps secure your loan. Typically, putting down a larger percentage can help you get better loan terms and lower monthly payments. A 60-40 portfolio is a classic investment mix, split between 60% stocks for growth and 40% bonds for stability. It is designed to balance risk and reward nicely. A crypto wallet is basically a digital tool that lets you securely store, send, and receive your digital currencies like Bitcoin or Ethereum. A trader usually sets up a strangle when they anticipate a huge price swing in either direction, but they are not sure which way it will actually go. A bear put spread is an options strategy where you buy a put option at a higher strike price and sell another put option at a lower strike price to profit from a moderate price drop while keeping your upfront cost limited. Company assets are basically all the valuable things a business owns, like cash, inventory, equipment, and buildings, which help them run and generate revenue. Real asset investing means placing your money into tangible, physical properties like real estate, farmland, precious metals, or infrastructure, rather than purely digital or financial securities. These physical items often serve as a great hedge against inflation, since their intrinsic worth usually climbs alongside rising prices. Headline inflation is the total measure of price changes across a massive basket of goods and services, including food and energy costs, which tend to bounce around quite a bit from month to month. Tax planning helps you minimize your overall tax liability by taking advantage of deductions, credits, and smart timing for your income and investments. Staying proactive means you keep more of your hard-earned money to put toward your financial goals. Wage inflation happens when overall pay and salaries rise across the job market, usually because employers are competing for workers in a tight labor pool. When companies pay higher wages, they often raise prices on their goods and services to cover those costs, which drives up general living expenses. A loan default happens when a borrower misses multiple scheduled payments and fails to uphold the repayment terms outlined in their lending agreement. This can seriously hurt your credit score and give the lender the right to take legal action or seize collateral. A mortgage renewal happens when your current term ends and you sign a new agreement with your lender, often to adjust your interest rate or payment schedule. It is a great chance to shop around and see if another lender offers a better deal for the remaining balance. A monetary policy pause happens when a central bank decides to hold benchmark interest rates steady instead of raising or lowering them. It basically gives policymakers a moment to assess how earlier rate adjustments are impacting inflation and overall economic growth before making another move. Holding some cash during a market downturn can give you a nice cushion and the flexibility to buy great stocks at a discount. However, keeping too much sidelined might cause you to miss out on the eventual market recovery. ETF liquidity refers to how easily you can buy or sell shares of an exchange-traded fund on the market without causing big price swings. It is usually determined by both the trading volume of the fund itself and the underlying securities it holds. Owning equities in retirement can still be helpful for long-term growth and beating inflation, but many people shift towards safer investments as they age. It really depends on your personal comfort with risk and how much income you need right away. Investors can streamline their portfolios by consolidating duplicate accounts, utilizing broad market index funds, and automating their contributions. This keeps things organized and cuts down on the hassle of tracking too many individual holdings. A bank run occurs when a massive wave of depositors suddenly rush to withdraw all their funds at the same time because they fear the institution is about to fail. Since banks only keep a fraction of their deposits on hand in cash, this sudden panic can quickly drain their reserves and force them into collapse. The Producer Price Index tracks the average changes in prices that domestic producers receive for their goods and services. It is a helpful tool for spotting potential inflation trends before they actually hit everyday consumers at the store. An employer match is a fantastic workplace benefit where your company deposits extra funds into your retirement account based on how much you choose to save. It is essentially free money, so it is always smart to contribute enough to grab the full amount. A business becomes profitable when its total revenue from sales surpasses all the expenses required to run operations. Keeping costs under control while driving strong customer demand is the key to achieving that positive bottom line. It is always thrilling to see green arrows on the screen when the market climbs. Watching those values rise is definitely one of the most exciting parts of tracking investments. A mutual fund pools money from many different people to purchase a diversified basket of stocks, bonds, or other assets all at once. It is an easy way to spread out your risk without having to pick individual investments yourself. Making financial choices based on fear or excitement often leads to buying high and selling low at the worst possible moments. Sticking to a calm, well thought out plan helps protect your hard earned money from wild market swings. The S&P 500 is a stock market index that tracks 500 of the largest publicly traded companies in the United States. It is widely used as a key gauge of how the overall stock market is performing. A market order is a quick instruction to buy or sell a security immediately at the best available current price. It prioritizes speed over getting a specific price. A balance sheet is a financial statement that gives a snapshot of what a company owns, what it owes, and the owner's equity at a specific point in time. Inflation typically happens when the overall demand for goods and services outpaces the available supply, causing prices to rise. Another common factor is when the cost of producing items increases, which businesses pass along to shoppers. The debt avalanche strategy focuses on paying off the account with the highest interest rate first while making minimum payments on the rest. It is a fantastic way to minimize total interest charges over time. A dividend stock is a share in a company that regularly shares a portion of its profits directly with its shareholders as cash payouts. It is a wonderful way to generate some steady passive income alongside potential growth. An RRSP is a special tax-advantaged account designed to help Canadians save up funds for their retirement years. Contributions made to this plan can even help lower your taxable income for the year. A lagging indicator is a metric that changes only after the broader economy or financial trend has already shifted its direction. These data points help analysts confirm long-term patterns rather than trying to predict what will happen next. A distributing ETF automatically pays out any dividends or interest earned from its holdings directly to your cash account instead of reinvesting them automatically. It is a handy option if you prefer receiving regular cash flow from your investments. A yield curve is a line that graphs interest rates on bonds across different contract lengths to show how borrowing costs compare over time. It is a super helpful tool that folks watch closely to gauge the overall health of the economy. Investment alpha measures how much a portfolio outperforms its benchmark index, showing the true value added by the manager's strategy. It is basically the excess returns generated above what the broader market produced. The Nasdaq is a major stock exchange that features a heavy concentration of top technology and growth companies. It is a fantastic benchmark for seeing how the tech sector is performing overall. Nominal GDP measures the total value of all finished goods and services produced within a country using current market prices, without adjusting for inflation. It gives us a quick snapshot of overall economic activity right now. Thematic investing is a strategy that focuses on backing companies driving long-term trends, like artificial intelligence or clean energy. It is a neat way to put your money behind the big macro shifts shaping our future. Sorting out your money milestones usually starts by covering basic safety nets like an emergency fund, then tackling high-interest debt, and finally focusing on long-term savings. A really popular guideline is the 50-30-20 rule, which suggests putting 20% of your take-home pay towards savings and financial goals. It is a super flexible way to build your nest egg while still covering your everyday lifestyle. Tangible book value is a metric that calculates a company's net worth by taking its total assets, subtracting all liabilities and intangible assets like patents or goodwill, and dividing the rest by the total shares. It gives us a very clear picture of what the company would be worth if it liquidated everything physically on hand today. Your debt-to-income ratio compares your monthly loan payments against your gross monthly earnings to show lenders how well you manage your borrowings. Keeping that percentage low makes it much easier to qualify for a mortgage or other credit. Venture capital is a type of private funding provided by investors to startups and early-stage companies that show strong potential for rapid growth. It is a vital fuel for innovative businesses that need large amounts of capital before they start turning a profit. A bank deposit is simply putting your cash into a financial institution for safekeeping, where it can sit securely in a checking or savings account while earning a little bit of interest. An investment bank helps companies raise capital by underwriting securities and guiding them through major corporate deals like mergers or acquisitions. They essentially act as financial matchmakers for big businesses and institutional investors. Equal weight investing gives the exact same dollar allocation to every single company in a portfolio, meaning smaller firms have just as much influence as the giants. It is a neat alternative to market cap weighting that helps spread out your risk. Financial leverage happens when people or companies use borrowed funds to purchase assets, hoping the returns will outweigh the interest costs. It can really amplify your potential gains, but it definitely increases your risk too. A common rule of thumb is to keep your housing costs under 30% of your gross monthly income. That leaves plenty of breathing room for other living expenses and savings. An IPO, or initial public offering, is the exciting moment a private company offers its shares to the public for the very first time on the stock market. ETFs are usually super tax efficient because of how they handle share creations and redemptions through in-kind transactions, which helps avoid triggering capital gains distributions for everyday investors. The labor force participation rate measures the percentage of the working age population that is either currently employed or actively looking for a job. It is a key economic indicator that helps us understand the overall health of the job market. Net worth is basically your total financial health score, calculated by adding up all your assets and subtracting whatever you currently owe in liabilities. Megacap companies are massive publicly traded corporations with market values usually exceeding $200 billion. Think of global tech giants and household brand names that dominate their respective industries. Carrying heavy debt can weigh deeply on someone's mind, often causing constant worry and sleepless nights. Alleviating that financial burden usually brings a massive sense of relief and improved well-being. Writing covered calls limits your potential profits if the stock skyrockets, because you might be forced to sell your shares at the agreed strike price. Plus, you still bear the risk of a steep drop in the underlying stock's value. A bank loan is a sum of money borrowed from a financial institution that you agree to pay back over time with added interest. It is a super common way to fund big purchases like a house or a car. The debt snowball method gives you quick wins by having you pay off your smallest balances first, which builds amazing momentum and keeps you excited to keep going. A growth stock is shares in a company that is expected to grow at an above-average rate compared to the rest of the market. They usually reinvest their earnings into expansion instead of paying big dividends. Budgeting gives you total clarity over your spending habits, ensuring you always live within your means and steadily build savings. It is such a helpful tool for keeping your financial goals right on track. An investment bank helps companies raise capital by underwriting securities and guiding them through major deals like mergers and acquisitions. They basically act as financial advisors for massive corporate transactions. A coincident indicator is an economic metric that moves right along with the current state of the overall economy, giving us a real-time snapshot of how things are going. It is super handy for figuring out where we stand financially at this exact moment. A personal loan is an unsecured chunk of cash borrowed from a lender that you pay back in fixed monthly installments over a set period. People often use them to consolidate credit card debt or handle unexpected expenses. Retail sales measure all the money spent at stores and restaurants, giving us a really good look at how much consumers are shopping. It is a key metric economists use to see if people are feeling confident enough to spend their cash. Volatility crash happens when option prices suddenly plummet after a major event like an earnings report because the expected market uncertainty disappears. It can really catch traders off guard if they aren't paying close attention. Compound interest is basically earning interest on both your initial money and the interest that keeps piling up over time. It helps your savings snowball faster the longer you leave it untouched. When interest rates go up, getting a mortgage becomes more expensive, which usually cools down the housing market because fewer people can afford to buy. It is all about how borrowing costs shape buyer demand. Generally, it is best to keep your emergency fund completely separate so you have a safety net for sudden surprises. Tapping into it to clear debt can leave you vulnerable if another unexpected expense pops up right after. Aim to stash away 3 to 6 months worth of your essential living expenses so you are fully covered if something unexpected pops up. Spreading your investments across different industries helps protect your portfolio because if one sector dips, others can keep things balanced. It is a fantastic way to lower your overall risk while still growing your wealth. Yield chasing happens when investors hunt down the highest paying returns, often by taking on way more risk than they realize. It can be super tempting, but it usually exposes you to unexpected dangers. When interest rates rise, the cost of borrowing goes up, which means your monthly loan payments will increase as well. It makes every borrowed dollar pricier over the life of the loan. Longer loans accumulate more interest over time because you are spreading out the repayments across a much greater period. Even if the monthly payment is smaller, the total cost adds up significantly. Return on invested capital tells us how efficiently a company turns its money into profitable growth. It is super helpful for spotting businesses that make the most out of every dollar they put to work. Investment alpha basically measures how well a portfolio performs compared to a broad market benchmark. It is a great way to see if a strategy is truly beating the average. When demand for a product goes up while supply stays the same, sellers can usually charge higher prices because more people want it. It is all about the balance between how much buyers want something and how much of it is actually available. A yield curve is simply a chart that plots bond interest rates across different maturity dates, helping us see how short-term and long-term borrowing costs compare. Usually, it slopes upward since investors expect higher payouts for locking away their cash for longer periods. Amortization is just the process of gradually paying off a debt through scheduled regular payments over time. Each payment covers both the interest charges and a portion of the original loan balance until it is fully zeroed out. Market cycles typically move through four distinct phases, including accumulation, markup, distribution, and markdown. These stages help us track the natural ebb and flow of economic trends. The unemployment rate measures the percentage of able workers who are actively looking for a job, but currently do not have one. It is a key health check for the overall economy. A bull put spread is an option strategy where you sell one put option and buy another at a lower strike price to collect a net credit. It is typically used when you have a moderately bullish outlook and want to limit your potential downside risk. Book value is essentially the net worth of a company found by taking its total assets and subtracting all liabilities. It shows what shareholders would theoretically receive if the business liquidated everything today. A good net worth varies a lot depending on your age and life stage, but a common guideline is having your annual salary saved by age 30. The most important thing is focusing on steady personal growth and consistency over time. Longer loans accumulate more interest over time because you are stretching out the repayment period, which really adds up. Monetary policy refers to the actions taken by a central bank to manage the money supply and interest rates to keep the economy stable. They use tools like adjusting rates to control inflation and encourage steady growth. An investment time horizon is the total length of time you plan to hold an asset before needing to access the funds. It really helps shape how much risk you might want to take on. A credit limit is simply the maximum amount of money a lender will let you borrow on your credit card at any given time. Staying well below that cap helps keep your credit score healthy. Gamma risk measures how fast an option's delta changes when the underlying stock price moves. It is super important to watch because high gamma means your position's sensitivity can shift rapidly overnight. Risk capacity is basically how much financial loss you can comfortably handle without hurting your essential lifestyle or long-term goals. It really depends on your income, savings, and timeline. Strong passwords protect your private financial accounts from unauthorized access and keep your hard-earned money safe from online threats. A Dividend Aristocrat is an amazing company in the S&P 500 that has successfully increased its dividend payouts for at least 25 consecutive years. These firms are usually super reliable and well established. Asset allocation matters because spreading your money across different types of investments helps balance potential growth with overall risk. It is a fantastic way to protect your portfolio from big market swings. A passively managed fund simply tracks a market index, like the S&P 500, rather than having a manager actively pick individual stocks. The yield curve matters because it shows the relationship between short-term and long-term interest rates, which often helps economists gauge the future direction of the economy. An inverted curve, where short rates are higher, has historically been a reliable indicator of an upcoming recession. Position sizing is super crucial because it helps you control how much money you are risking on a single trade. By keeping your bets proportional to your total account, you protect yourself from taking massive hits when the market turns. Free cash flow is the cash a company has left over after paying all its operating expenses and capital expenditures. It is a great sign of financial health because it shows the business can generate real cash to fund new projects or share with investors. When you short a stock, your potential loss is technically unlimited because the price of the asset can keep climbing forever. That is why managing your risk carefully is so important in trading. Lean Fire is a minimalist approach to financial independence, where people save aggressively to retire early on a very lean and modest yearly budget. A stock option is a contract that gives you the right to buy or sell a specific stock at a set price before a certain date. It can be a neat way to leverage your trades, but it definitely takes some careful strategy. The debt avalanche method focuses on tackling your highest interest rate debt first to save the most money overall, while the snowball method has you clear out your smallest balances first for quick psychological wins. 401k is a fantastic employer-sponsored retirement account that lets you save a portion of your paycheck before taxes are taken out, which really helps your long-term savings grow much faster. The rule of 72 is a quick mental math trick to figure out how long it will take for your investments to double. You just divide the number 72 by your annual interest rate. A labor force participation rate measures the percentage of the working age population that is either currently employed or actively looking for a job. It is a key metric economists use to see how active the job market really is. Deposit insurance is super important because it protects your hard-earned money in the bank up to a certain limit if the institution ever fails. It gives people great peace of mind knowing their savings are completely safe. Think of a stock option as a handy agreement that lets you buy or sell shares at a fixed price later on. It adds plenty of flexibility to your portfolio if you play your cards right. It is usually best to balance both by grabbing any employer match on retirement funds first, then hammering away at high-interest debt. Disinflation is simply a slowdown in the rate of inflation, meaning prices are still going up, but at a much slower pace than before. It is different from deflation, where prices actually start dropping. Compound interest is amazing because it lets you earn returns not just on your initial money, but also on the previous earnings that pile up. Over time, that snowball effect really helps your wealth accelerate faster and faster. That's a great question. What are your thoughts on it? Open interest simply tracks the total number of active options contracts that haven't been settled yet. It is a great way to see how much money and market activity are flowing into a specific option. decentralized exchange is a peer-to-peer marketplace where folks can trade crypto directly without needing a traditional middleman or central authority. When a company creates and sells brand new shares, the total count of stock in circulation increases. Because the overall pie is split into more pieces, each existing share represents a smaller percentage of ownership and a smaller share of future profits. JAMA measures how fast an options delta changes when the stock price moves. It is basically the speed of your speed in options trading. A DRIP is a dividend reinvestment plan that lets you automatically use your cash dividends to buy more shares of that same company without paying extra fees. Building a solid credit history usually takes around 6 months of consistent, on-time payments and responsible account management. Everyone's journey is a bit unique, but keeping your balances low and paying on time is the best way to get there. An employer match is basically free money, where your company contributes to your retirement account based on how much you save yourself. It is a fantastic perk that you definitely do not want to miss out on. Paying off your mortgage early saves you a ton on interest charges over time, but you might earn more by investing that spare cash elsewhere instead. It really comes down to your personal comfort with debt and what brings you peace of mind. An ETF premium happens when its market price climbs higher than the actual net value of its underlying holdings. It usually pops up when demand for the fund surges. A momentum stock is a company whose share price has been on a strong upward trend, and traders jump in hoping that the existing upward energy will keep pushing the price higher. GDP per capita measures the total economic output of a country divided by its total population. It gives us a helpful snapshot of the average economic well-being or standard of living for people living there. Tax loss harvesting involves selling underperforming investments at a loss to offset your taxable capital gains and lower your overall tax bill. It is a clever strategy to turn a rough market dip into a helpful tax advantage. Accounts receivable is simply the money that customers owe your business for products or services they have already received on credit. It gets listed as an asset on your balance sheet because you expect to collect that cash soon. Consumer confidence is a huge deal because it tells us how optimistic everyday shoppers feel about their personal finances and the overall economy. When people feel secure, they tend to spend more, which really drives business growth and keeps our economy moving forward. A micro-cap stock refers to a company with a very small total market value, usually ranging from $50 million to $300 million. These smaller businesses can have massive growth potential, but they also tend to be much riskier and more volatile. An IPO, or initial public offering, is the exciting moment when a private company first sells its shares to the general public on the stock market. A crypto exchange is a digital marketplace where you can buy, sell, and trade various digital currencies like Bitcoin or Ethereum. Gold is often seen as a safe haven asset that holds its value well during times of inflation or market uncertainty. Many people buy it to protect their wealth when other markets get a bit rocky. Your debt-to-income ratio compares all your monthly debt payments to your total monthly gross income. Lenders use this helpful percentage to figure out how well you can manage your monthly repayments and handle new loans. Your time horizon is super important because it determines how much risk you can comfortably take with your investments. If you have a longer timeline, you can usually ride out short-term market drops and focus on growth. A market correction happens when major stock indices drop by 10% or more from their most recent highs. It is totally normal behavior and usually helps cool down an overheated market. A bank's loan-to-deposit ratio compares total loans issued to total customer deposits held, showing how much liquidity the bank maintains. It is a key metric for evaluating whether a lender is managing its capital wisely. A bear call spread is an option strategy you use when you expect a stock's price to drop or stay flat. You sell a call option at a lower strike price and buy another call option at a higher strike price to limit your potential risk. Market maker hedging happens when financial firms trade underlying assets to balance out the risks from option contracts they sold to clients. It is basically a way for them to stay neutral and protect themselves if the market suddenly swings in either direction. Socially responsible investing is a strategy where you put your money into companies that actively support positive environmental, social, and governance causes. It lets you grow your wealth while also backing businesses that make a real difference in the world. Fund turnover shows how frequently the securities inside a mutual fund, or ETF, are bought and sold by the manager. A lower turnover ratio usually means lower transaction costs and better tax efficiency for you as an investor. A dividend aristocrat is a special company in the S&P 500 that has increased its dividend payouts for at least 25 consecutive years. These companies are usually very stable and reliable choices for folks who love earning steady passive income. An angel investor is an affluent individual who provides vital capital to early-stage startup companies in exchange for equity ownership. They often mentor founders and help new businesses get off the ground. A unicorn company is a privately held startup valued at over $1 billion. These rare businesses are usually tech-focused and scale very quickly. The Sharpe ratio evaluates how much excess return you get for the extra volatility you take on by holding a riskier asset. It is a fantastic tool for seeing if your investment gains are truly worth the bumpy ride. A high-yield exchange-traded fund focuses on delivering substantial dividend payouts to investors, usually by holding assets like high-paying corporate bonds or dividend stocks. It is a popular pick for anyone wanting to boost their regular cash flow. Companies usually reduce their dividend payouts when they need to preserve cash during tough financial times or want to fund new growth projects. It is a protective move to keep the business stable. A vertical spread involves trading options at the same expiration date, but different strike prices to limit both your potential profit and risk. It is a really popular way to trade when you have a specific outlook on where a stock's price is headed. A commodity ETF is an exchange-traded fund that tracks the performance of physical goods like gold, oil, or agricultural products. It gives you a simple way to invest in raw materials without having to store them yourself. Factor investing is a strategy where you target specific drivers of returns, like value, size, or momentum, to try and beat the broader market. It is like building your portfolio using specific ingredients that historically have given you an extra edge. A smart contract is a self-executing digital agreement stored on a blockchain that automatically carries out transactions when preset conditions are met. It removes the need for middlemen, making processes super secure and efficient. A momentum stock is a company whose share price has been showing a strong upward trend recently. Investors often jump into these to ride the wave of that existing energy and excitement in the market. An iron butterfly is an advanced options strategy where you combine a put spread and a call spread with the same expiration date to profit when a stock stays relatively stable. A mortgage is basically a specialized loan that you use to buy a home, and you pay it back with interest over a set period like 15 or 30 years. Real estate leverage means using borrowed money, like a mortgage, to buy a property so you can control a larger asset with a smaller amount of your own cash. It can definitely amplify your potential returns, but it also increases your risk if the property value drops. An ETF discount happens when its market price drops slightly below the actual net asset value of the underlying holdings. It can create a nice buying opportunity for savvy shoppers in the market. An iron condor is an option strategy where you sell both a put spread and a call spread to make a profit if the underlying asset stays within a specific price range. Large cap stocks are shares of massive, well-established companies with huge market values, usually over $10 billion. They are typically seen as more stable choices because these businesses have proven track records. Predatory lending involves unfair, deceptive, or fraudulent loan terms that take advantage of borrowers, often hiding massive fees and impossible interest rates. It is definitely something we want to watch out for to keep our finances safe. A normal yield curve is a line on a chart showing that longer-term bonds offer higher interest rates than short-term ones because of the extra time and risk involved. It usually reflects a healthy, growing economy. Forward PE is a valuation metric that divides a company's current share price by its estimated future earnings per share. It helps investors gauge how expensive a stock is relative to what analysts expect the business to earn down the road. A stock represents a tiny fractional ownership share in a publicly traded company. When you buy one, you essentially own a little piece of that business. Refinancing means replacing your current loan with a brand new one, usually to secure a lower interest rate or better monthly payments. It is a super popular way to save some extra cash over time. Companies buy back their own shares to reduce the total number available in the open market, which usually helps boost the value of the remaining stock. It is a popular way to return extra cash to shareholders. The money supply refers to the total amount of currency and other liquid assets circulating in a country's economy at any given time. Value investing is a strategy where you hunt for bargain stocks that might be trading for less than they are actually worth. It is all about finding those hidden gems the rest of the market is overlooking. Compound interest is amazing because it lets you earn returns not just on your initial savings, but also on the accumulated interest from past periods. It creates a wonderful snowball effect that helps your wealth grow much faster over time. A drawdown is crucial because it measures the peak to trough decline of your investments, showing you the exact financial risk and potential recovery time you might face during a market slump. Dividend investing is a strategy where you buy shares in companies that regularly pay out a portion of their profits to shareholders. It is a fantastic way to generate some steady passive income. Buy and hold investing is a strategy where you purchase assets and keep them for a long period, ignoring short-term market dips. It is a super relaxing way to build wealth over time without stressing about daily price swings. Inflation usually happens when the demand for goods and services outpaces the economy's ability to produce them, causing prices to rise. Printing too much currency can also dilute its purchasing power over time. Markets bounce back after slumps because strong businesses adapt, innovate, and continue generating profits as the overall economy heals. Investors also tend to step in and scoop up those heavily discounted shares, driving prices back up. You can keep your account safe by using strong, unique passwords and turning on two-factor authentication for an extra layer of security. It is also smart to regularly check your statements for any activity you do not recognize. crypto bull market happens when digital asset prices surge consistently over a long period, driven by high investor optimism and heavy buying. It is a wild ride where digital currencies hit brand new highs. Market crashes usually happen when sudden panic sets in, causing everyone to sell off their shares at the same time. Economic shocks, sudden policy shifts, or overhyped asset bubbles bursting can also trigger a massive wave of fear. During a market recovery, investor confidence starts returning as businesses show steady earnings, growth, and economic indicators improve. People begin buying up quality assets again, which pushes prices upward and helps heal the previous losses. Downside risk is the chance that your investment could suffer a financial loss if its price drops below what you originally paid for it. Delta in options trading measures how much an options price is expected to move when the underlying stock price changes by $1. It is super helpful for gauging your risk exposure. An exchange-traded fund is basically a basket of different securities like stocks or bonds that you can buy and sell all at once on an exchange. It is a super popular way to get instant diversification without having to pick individual companies. Gross margin is the money a company keeps after paying the direct costs associated with making its products. It shows how efficiently a business is running its core operations. Investment alpha is a measure of how well a portfolio performs compared to a benchmark index. It basically shows the excess returns generated by clever management rather than just following general market trends. The PEG ratio compares a company's price-to-earnings ratio to its expected earnings growth rate. It helps investors figure out if a stock is fairly valued based on how fast the company is growing. Saving half of your income is definitely an ambitious goal, but it is totally doable if you carefully cut back on non-essential spending and live below your means. Many people in the financial independence community follow this path to reach their goals much faster. The price-to-earnings ratio is calculated by taking a company's current stock price and dividing it by its earnings per share. It is a super handy metric for seeing how much investors are willing to pay for each dollar of company earnings. Diversification is definitely not overrated because spreading your money across different assets helps protect your portfolio if one sector takes a sudden hit. It is one of the smartest ways to manage risk while still chasing steady long-term growth. The EV/EBITDA metric compares a company's total enterprise value to its earnings before interest, taxes, depreciation, and amortization. It is super useful for evaluating whether a business is fairly priced compared to its industry peers. Market cap weighting is an indexing method where companies are held in proportion to their total market value, meaning larger firms have a much bigger influence on the index's overall performance. A capital gain is the profit you pocket when you sell an asset for a higher price than what you originally paid for it. Paying yourself first means setting aside money for your savings and investments before you spend anything on bills or fun stuff. It is a brilliant habit that guarantees you hit your financial goals every single month. A loan default happens when a borrower fails to make their scheduled payments over a specific period. Lenders take this very seriously, and it can severely damage your credit score. Companies usually split their shares to lower the individual price tag, which makes the stock much more accessible for everyday retail buyers. It does not change the actual value of the company, but it often brings a nice wave of fresh trading activity. A straddle is an option strategy where you buy both a call and a put option at the same strike price. It lets you profit if the stock makes a massive move in either direction, no matter which way it goes. Refinancing a mortgage means replacing your current home loan with a brand new one, usually to secure a lower interest rate or better monthly payments. It is a smart move when rates drop so you can save a bunch of cash over the life of the loan. When the central bank increases the money supply, it generally lowers borrowing costs and boosts consumer spending. But too much liquidity can eventually spark inflation. Keeping a close eye on that balance is super important for healthy economic growth. Keeping private keys secret is crucial because anyone who has them gains total control over your digital assets. If they get exposed, your funds can be transferred away instantly with zero possibility of a reversal. Setting aside money for yourself first guarantees you consistently build your savings before daily spending eats up your cash. It is an amazing habit that keeps your financial goals right on track. Two-factor authentication adds an extra layer of security by requiring two different forms of identification before you can log into an account. It usually combines something you know, like a password, with something you have, like a verification code sent to your phone. A bank deposit is simply putting your cash into a financial institution for safekeeping, where it can also earn a little bit of interest over time. Intrinsic value represents the actual calculated worth of an asset based on its fundamental financial strength, independent of its current market price. It is super helpful for spotting when a company is trading at a bargain. Industrial production measures the total output of manufacturing, mining, and utilities in a country. It is a fantastic indicator to watch because it gives us a clear picture of how strong the manufacturing sector and overall economy are performing. Inflation risk is the danger that the purchasing power of your money will drop over time as the general price level of goods and services rises. It means the cash you have saved will buy you less in the future. The REIT is a company that owns and operates income-producing real estate, letting everyday people invest in large properties just like regular stocks. collar strategy is an options trading technique where you hold a stock while simultaneously buying a protective put and selling a covered call to limit both your potential losses and gains. A balance transfer lets you move your credit card debt over to a new card, usually to take advantage of a lower interest rate and save some money. Customer lifetime value helps businesses understand the total revenue they can expect from a single customer over the entire relationship, which guides smart spending on marketing and retention. The debt avalanche method focuses on tackling the highest interest rate first to save the most money, while the snowball method starts with the smallest balance for quick wins. Both are fantastic strategies, so it really comes down to whether you prefer saving on interest or feeling that extra motivation from knocking out accounts fast. Building an emergency fund really depends on your monthly savings rate and living expenses, but setting aside a small amount from every paycheck adds up surprisingly fast. A consumer price index tracks how the average prices paid by urban consumers for a basket of goods and services change over time. It is one of the main tools we use to keep an eye on inflation. A mortgage is a specific type of loan you use to buy a home, and you pay it back over time with interest to the lender. Return on invested capital measures how efficiently a company allocates its funds toward profitable ventures. It is super helpful for spotting businesses that know how to turn their investments into solid, long-term growth. Dividend yield is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. It is a handy way to see the cash flow return you are getting on your investment. Markets bounce back after crashes because businesses eventually adapt, grow their earnings, and find new ways to create value. Plus, Investors love stepping in to buy wonderful companies at a massive discount when prices drop low. Data measures how much a stock's price jumps around compared to the broader market as a whole. A higher number means it tends to be more volatile, while a lower number indicates smoother sailing. Tail risk refers to those rare, extreme market events that lie way out on the bell curve and usually catch people completely off guard. Even though they have a low probability of happening, it is super important to keep them in mind so your portfolio stays protected. A distributing ETF automatically pays out all the dividends and interest collected from its underlying holdings directly to your brokerage account. It is a wonderful choice if you want to generate regular passive income from your investments. A high price-to-earnings ratio usually tells us that investors expect the company to grow its profits significantly faster in the future. It can mean the stock is priced at a premium because everyone is super excited about its potential. Market liquidity refers to how easily you can buy or sell an asset without causing a major swing in its price. Assets like cash are super liquid, while real estate takes a bit longer to trade. When a company buys back its shares, it reduces the total number available on the market, which can help increase earnings per share. It is a popular way for firms to reward investors and signal that management believes the stock is a great value. A startup valuation is the process of figuring out how much a young, emerging company is worth today. Investors use future growth potential, team strength, and market size to arrive at that number. Debt can actually be a great tool if used to acquire assets that grow in value or generate income, like a mortgage for a home or a loan to start a business. The key is making sure the returns you earn outweigh the borrowing costs. An expiration date is the final deadline when a financial contract, like an option, becomes completely void and worthless. It is super important to keep track of so you do not get caught off guard. Unsecured debt is money you borrow without having to put up any collateral, like a house or car, to back it up. Credit cards are a great everyday example since lenders rely purely on your creditworthiness to approve them. Downside risk is the chance that an investment will drop in value or suffer a loss if market conditions turn sour. It is basically measuring the worst-case scenario for your portfolio. That's a great question. What are your thoughts on it? An exchange-traded fund trades throughout the day on an open stock exchange, just like a regular stock, whereas a mutual fund is only priced and traded once a day after the market closes. A short-term financial goal is a money target you want to hit soon, usually within a year, like saving up for a fun vacation or building a starter emergency fund. A competitive moat is a unique advantage that helps a business protect its market share from hungry rivals. Think of it like a castle defense that keeps a company strong and profitable over the long haul. A call option is a financial contract that gives you the right, but not the obligation, to buy a stock at a set price before a specific date. Shareholder equity represents the actual net worth of a company, calculated by subtracting all liabilities from its total assets. It essentially shows what would remain for the owners if every debt were paid off. An actively managed fund is a pool of money where a professional manager or a team makes specific choices on what to buy and sell, aiming to beat the overall market returns. A payday loan is a small, short-term cash advance meant to tide you over until your next paycheck, though they typically carry extremely high interest rates and fees. put option gives the holder the right to sell a specific stock at a set price within a certain time frame, which is great for protecting against falling prices. When interest rates go up, borrowing gets pricier for companies, which can slow down their growth and often weigh on stock prices. It is all about how borrowing costs ripple through the broader economy. Credit expansion happens when banks ramp up their lending activity, putting more money into circulation and making it easier for folks and businesses to borrow. A buy now pay later service lets you purchase items immediately and split the total cost into smaller, manageable installments over time, usually without any interest if paid on schedule. Total return is super important because it gives you the complete picture of your investment's performance by combining any dividends or interest earned with price changes. It shows your actual overall earnings. A mortgage stress test is a financial check where lenders evaluate whether you could still afford your loan payments if interest rates were to rise significantly in the future. The TFSA, or tax-free savings account, is an incredible tool that lets your investments grow without ever paying taxes on the money you withdraw. Compound interest is when the interest you earn on your savings or investments gets added to the original amount, so you start earning interest on both, which can really help your money grow over time. Companies hand out dividends to share a portion of their profits directly with their shareholders as a nice reward for investing in them. It is a great way for businesses to show confidence in their financial health. Inflation risk happens when the rising cost of living gradually eats away at the purchasing power of your money over time. It means the cash you save today might not buy you the same amount of goods down the road. The unemployment rate measures the percentage of people in the labor force who are currently jobless and actively looking for work. It is a key indicator of overall economic health. Position sizing helps you manage risk by figuring out how much of your total money to put into a single trade. It is a fantastic way to protect your account from taking a massive hit if the market suddenly turns against you. A mortgage stress test is basically a financial check to see if you can still comfortably make your loan payments if interest rates were to climb higher in the future. An IPO valuation is the process investment bankers use to determine how much a private company is worth before its shares are officially offered to the public on the stock exchange. Portfolio rebalancing is the process of realigning the weightings of your investments to match your original risk goals. It usually involves selling some assets that have grown a lot and buying others to keep your portfolio properly diversified. A financial goal is a specific target you set for how you want to save, spend, or invest your money in the future. Having a clear objective makes it much easier to stay motivated and build a solid plan. Tax planning is important because it helps you minimize the amount of taxes you owe, which can save you money and reduce financial stress, allowing you to keep more of your hard-earned income. Long-term investing is all about holding onto your assets for years or even decades to ride out market bumps and build serious wealth over time. A really popular rule of thumb is to save 20% of your take-home pay for future goals and emergencies. It is a fantastic way to steadily grow your savings without feeling overwhelmed. A shareholder is simply anyone who owns at least one share of stock in a company, making them a partial owner of that business. Gross margin tells you what percentage of revenue is left over after subtracting the direct costs associated with making your products. It is a super helpful metric for seeing how efficiently a company turns its sales into actual profit. Bitcoin has a capped limit of 21 million coins ever created, which was built right into its code by the creator to prevent inflation. That scarcity is a huge reason why many people compare it to digital gold. Business confidence measures how optimistic or pessimistic company leaders are about the overall direction of the economy and their own financial prospects. When leaders feel positive, they tend to invest more and hire new people, which helps the whole market grow. Financial statements are super important because they give a clear picture of a company's financial health, performance, and cash flow. They help investors and leaders make smart choices based on real data rather than just guessing. A crypto airdrop is when blockchain projects send free tokens directly to digital wallets to build excitement and reward early supporters. It is kind of like getting a surprise gift just for being part of the community early on. An actively managed fund is a pool of money where a professional manager makes specific buy and sell choices to try and beat the overall market returns. Bitcoin is a decentralized digital currency that lets people send and receive money across the internet without needing a traditional bank or middleman. A margin call happens when your broker demands that you deposit extra cash or securities because the value of your investments has dropped below a required minimum level. When there is more money flowing through the economy, people tend to spend and borrow more freely, which can spark growth but might also lead to higher prices if it outpaces actual goods. Monetary policy is typically managed by a country's central bank, like the Federal Reserve in the United States, which adjusts interest rates and the money supply to keep the economy stable. Consumer confidence is super important because it shows how positive everyday shoppers feel about their job security and finances. When folks feel secure, they are way more likely to open up their wallets and buy things, which keeps our whole economy moving forward. A rainy day fund is money you set aside specifically for unexpected expenses, like sudden car repairs or medical bills, so you don't have to stress when surprises pop up. Options can lose value after an earnings report because of a drop in implied volatility, which is often called the IV crush. Even if the company does well, the sudden release of uncertainty causes that price cushion to vanish quickly. Profit margins tell us how much actual cash a business gets to keep after paying all its operating costs. It is a fantastic way to see how efficiently a company turns its sales into real bottom-line earnings. A target date fund automatically adjusts your portfolio's mix of stocks and bonds over time, becoming more conservative as you approach your planned retirement year. Historical volatility looks at how much a security's price has bounced around in the past by measuring standard deviation over a specific time frame. It gives us a great numerical view of past price swings, so we can gauge how wild the ride might have been. Income investing is all about building a portfolio that generates regular cash payouts, like dividends or interest, rather than just waiting for asset prices to grow. It is a super popular strategy for anyone looking to secure steady, reliable returns to help cover everyday living expenses. Investors can easily streamline their holdings by using exchange-traded funds or broad market index funds to get instant diversification without needing to track dozens of individual companies. Long-term investing is all about buying quality assets and holding on to them for many years to let compound growth work its magic. It helps you ride out short-term market bumps while aiming for bigger financial milestones down the road. Your marginal tax rate is simply the percentage of tax you owe on your next single dollar of earned income. As your earnings step up into higher brackets, only that specific portion of income gets taxed at the elevated rate rather than your entire paycheck. Housing costs usually go up because there are more people wanting to buy or rent than there are homes available to live in. When supply cannot keep up with high demand, property values naturally climb higher over time. Market cap weighting is an indexing method where companies are held in proportion to their total market value, meaning larger corporations have a much bigger impact on the fund's overall performance than smaller ones. A credit limit is the absolute maximum amount of money a lender will let you borrow on your card. Staying well below that cap helps keep your credit score healthy. An emergency fund is a stash of money set aside specifically to cover unexpected expenses like car repairs or medical bills. Having 3 to 6 months of living expenses saved up gives you fantastic peace of mind. A cyclical stock belongs to a company whose performance closely follows the overall health of the economy, meaning it tends to thrive during economic booms and struggle during downturns. Automotive and travel companies are great classic examples of this pattern. JAMA exposure measures how much options dealers need to buy or sell the underlying stock to keep their portfolios balanced as prices shift. High levels can sometimes lead to faster market moves because dealers have to react quickly to those changing prices. A stock price typically drops when more people are selling shares than buying them, which often happens due to disappointing earnings, negative news, or an overall economic slowdown. Discounted cash flow analysis is a method used to estimate the value of an investment based on its expected future cash flows, which are adjusted back to their present value. It helps financial analysts figure out if a company is currently undervalued or overvalued in the market. Total return is the complete measure of an investment's performance, factoring in both capital appreciation and any dividends or interest earned along the way. It gives you the full picture of your profit or loss over a specific holding period. Delaying gratification lets you save and invest money up front instead of spending it right away, which allows compound growth to really work its magic over time. It is a powerful way to build serious long-term financial security. Venture capital is money provided by professional investors to help early-stage startups with massive growth potential get off the ground. In exchange, those backers receive an ownership stake in the young company. Missing a payment usually triggers late fees and can seriously lower your credit score if it gets reported to the bureaus. Lenders might also raise your interest rate as a penalty, so catching up quickly is super important. A trading edge is simply a unique strategy or advantage that gives an investor a better statistical chance of winning over the long run. It is what separates consistent traders from the rest of the pack. A collar strategy is a risk management technique where you hold a stock while simultaneously buying protective puts to limit losses and selling covered calls to help pay for that protection. It basically puts a floor and a ceiling on your potential portfolio swings. Interest rates directly influence how much it costs to borrow money for things like mortgages and car loans, while also determining how much returns you get on your savings accounts. When rates go up, loans become more expensive, which usually slows down consumer spending. Payment history carries the most weight in your credit score because lenders want to see a reliable track record of paying bills on time before they approve you for a loan. A common rule of thumb is to spend no more than 30% of your gross monthly income on housing expenses. This helps ensure you still have plenty of money left over for other important bills and savings goals. When an option expires worthless, it simply loses all of its value and the contract disappears from your account. The buyer loses the premium they paid, while the seller gets to keep that cash profit without any further obligations. A DRIP, or dividend reinvestment plan, allows you to automatically use your cash dividends to buy more shares of that same company without paying extra fees. It is a fantastic way to compound your holdings over time. Choosing between dividend and growth investing really comes down to your personal financial goals. Dividends give you regular cash payouts right now, while growth stocks focus on expanding quickly for massive capital gains down the road. Consignors take on the full legal responsibility to pay back the entire loan if the primary borrower stops making payments. It can seriously impact their own credit score and debt-to-income ratio if things go wrong. Real GDP measures the total economic output of a country adjusted for inflation, giving us a true picture of actual growth over time. A variable rate mortgage features an interest rate that can change periodically based on overall market conditions. This means your monthly payments might go up or down over the life of the loan, depending on how those rates shift. It is usually better to leave your emergency savings untouched and focus on tackling debt separately unless you are facing a true crisis. Draining your safety net can leave you completely vulnerable if an unexpected expense pops up. Hello there. It is so wonderful to see you in the chat again today. What exciting financial topics are we diving into next? Position sizing is crucial because it helps limit your potential losses on any single trade by only risking a small, predetermined percentage of your total capital. That way, a few bad market moves won't wipe out your entire portfolio. A passively managed fund is a type of investment portfolio that simply tracks a specific market index rather than trying to beat it. This approach typically leads to much lower management fees for everyone involved. Property management involves hiring a professional team to handle the daily operations, tenant communications, and maintenance of real estate investments. It is super helpful for owners who want to earn passive rental income without dealing with midnight repair calls. An annual percentage rate represents the yearly cost of borrowing money, including both the interest rate and any additional fees combined. It gives you a clear picture of the true expense associated with taking out a loan or credit card. A consumer price index is a handy gauge that tracks the average change in prices paid by urban consumers for a basket of everyday goods and services over time. It is basically our main tool for measuring inflation and seeing how the cost of living shifts. Refinancing means replacing your current loan with a brand new one, usually to secure a lower interest rate or better monthly terms. It is a great way to save some money over the life of the loan. Proof of work is a security mechanism used by blockchain networks to validate transactions and prevent digital fraud through complex computational puzzles. It requires miners to use significant computing power, which keeps the whole system secure and trustworthy. A credit report is a detailed history of your borrowing and repayment habits that lenders use to judge your financial reliability. It includes information about your credit cards, loans, and whether you pay your bills on time. Financial risk is simply the chance that you might lose money on an investment or not make as much as you planned. Every single investment carries some level of uncertainty, which is why balancing your portfolio is so important. A yield curve is a line that graphs interest rates on bonds across different contract lengths. It helps investors understand market expectations for future economic growth and borrowing costs. Market capitalization is found by multiplying a company's total number of outstanding shares by its current share price. It gives us a quick way to see the overall size and value of a publicly traded business. Financial freedom is all about having enough passive income or savings to cover your living expenses without needing to work a traditional job. It gives you total control over your time and choices. Debt consolidation means rolling multiple separate loans into a single monthly payment, often to secure a lower interest rate. It is a super handy strategy for making your monthly bills much easier to manage. An inverse ETF is designed to deliver the opposite daily performance of a specific index, so it goes up when the market drops. It is typically used by traders to hedge against losses or bet on a market downturn. Meme stocks usually blow up thanks to massive online hype, viral social media communities, and retail investors jumping in together for fun. It is a wild mix of internet culture and market trading. The S&P 500 is a major stock market index that tracks the performance of 500 of the largest publicly traded companies in the United States. It is often used as a key benchmark to gauge the overall health of the stock market. Credit utilization is simply the amount of revolving credit you are using compared to your total available limit. Keeping that ratio low is super important for maintaining a healthy credit score. Penny stocks are super speculative because they trade at very low prices and are often issued by tiny companies with little public data. That makes them prone to wild price swings and potential manipulation, so it is definitely a bumpy ride for investors. A yield curve plots interest rates on bonds with different maturity dates, showing the relationship between short-term and long-term borrowing costs. It is a helpful tool that economists use to gauge expectations about future economic activity and inflation. Net operating income is the total revenue a real estate property generates minus its necessary operating expenses. It is a fantastic metric to check the true profitability of an investment property before factoring in financing costs. When you short a stock, your potential loss is technically infinite because there is no limit to how high a share price can climb before you buy it back. It is definitely one of the riskiest trading moves out there. Dividend capture involves buying a stock right before its ex-dividend date to collect the payout, and then selling it quickly after. While it sounds easy, the stock price usually drops by the dividend amount on that date, making it pretty tricky to turn a reliable profit. A covered call is an option strategy where you hold shares of a stock and sell call options against them to generate extra income. It is a neat way to earn some cash, though you might have to sell your shares if the price shoots up past the strike price. Bad debt refers to money owed that is unlikely to be paid back, which businesses usually have to write off as a loss. It is definitely a headache to deal with for lenders. Meme stocks soar primarily due to intense viral attention across social platforms and online forums. It is fascinating to watch internet communities band together to drive up share prices. Variable expenses are costs that change from month to month, like your grocery bills or entertainment spending, unlike fixed bills such as rent. Tangible book value calculates a company's net worth by taking its total assets, subtracting intangible items like patents and goodwill, and then removing all liabilities. It gives you a really clear look at what the physical assets are truly worth. When borrowing costs rise, loans and credit card payments become much pricier for everyday shoppers. That usually means people have less extra cash to spend, which tends to slow down overall buying activity. Option delta measures how much an option's price is expected to change when the underlying stock moves by $1. It is a super helpful indicator for figuring out the sensitivity and risk of your positions. Discretionary spending covers all those non-essential purchases like dining out, hobbies, and vacations that we choose to make after paying for our mandatory bills. It is the first place people look when they want to free up extra cash for savings. Cryptocurrency is a digital currency that uses cryptography for security, making it super tough to counterfeit. It operates on a decentralized network called blockchain rather than relying on a central bank. Most folks like to check and rebalance their portfolios about once or twice a year to keep their asset mix on track. It is a great way to make sure your risk level stays right where you want it. Options can lead to massive gains because they give you control over a large block of shares for a fraction of the stock's actual price. That leverage means even a small shift in the market can translate into a huge percentage return on your initial investment. A capitalization rate is the expected rate of return on a real estate investment property, calculated by dividing its net operating income by its current market value. It is a handy metric for comparing the profitability of different properties. Welcome in. I am doing fantastic today and having a wonderful time hanging out with everyone on the stream. When supply goes down while demand stays high, prices tend to climb because people are competing for fewer available items. On the flip side, an oversupply usually causes prices to drop as sellers try to clear out their inventory. Banks pay interest on the money you keep with them because they use a portion of those funds to issue loans to other customers. By offering you a return, they incentivize you to save your cash in their institution rather than keeping it under your mattress. Return on equity measures how efficiently a company uses investments from its shareholders to generate net income. It is a fantastic metric for seeing how well management is growing profitability using the money owners have put into the business. Your debt-to-income ratio compares your monthly debt payments to your total monthly earnings to show lenders how well you can manage repayments. Lenders look closely at this percentage to decide if you are in a good position to take on a new mortgage or loan. Dividend capture is a trading strategy where someone buys a stock right before its ex-dividend date to collect the payout and then sells it shortly after. It is a quick way to target those cash distributions, though stock prices can fluctuate during that short turnaround. A rate hike happens when a central bank raises its benchmark interest rate to help cool down inflation. This usually makes borrowing money more expensive for everyone. Execution risk is the danger that a company might fail to successfully carry out its business plans or strategic initiatives. It is all about whether management can actually deliver on their promises. Greed can drive investors to chase soaring prices without looking at the underlying fundamentals, often creating dangerous speculative bubbles. When everyone rushes to buy purely out of FOMO, it usually leads to a sharp crash once reality sets in. When a company pays out a dividend, its share price typically drops by roughly that same cash amount on the ex-dividend date because value is leaving the business and going straight to the shareholders. An options chain is basically a complete list of all available call and put contracts for a specific stock, showing strike prices and expiration dates. It helps traders check out different pricing and volume details in one spot. An iron butterfly is an advanced options trading strategy that combines a put spread and a call spread with the same expiration date. Traders use this setup when they expect the underlying asset to stay relatively stable with very little price movement. Even profitable companies can run out of cash if their customers take too long to pay their invoices, while bills and payroll keep coming due right away. It is all about timing, because money earned on paper is not always sitting in the bank account ready to spend. A stock price usually dips when a company reports disappointing earnings, faces unexpected bad news, or when broader economic conditions cause investors to sell off shares. Market sentiment plays a huge role in those downward swings. Consistently timing the market is practically impossible even for seasoned pros, since nobody can accurately predict short-term price swings every single time. It is usually much safer to focus on long-term investing instead. Headline inflation measures the total change in the cost of living for a typical basket of goods and services, including food and energy costs. Because it tracks everything, those prices can sometimes bounce around quite a bit from month to month. Quantitative tightening is a monetary policy where a central bank reduces the liquidity in the economy by letting its bond holdings mature or selling them off directly. This helps combat high inflation by pulling money out of circulation. EBIT stands for earnings before interest and taxes, which shows a company's profitability from core operations without factoring in financing costs or tax obligations. It is a super helpful metric for comparing the core performance of different businesses. ETF distributions come from the dividends paid by the underlying stocks or the interest earned on bonds held within the fund. When those portfolio holdings make payouts, the fund passes that cash right along to its investors. An RRSP is a special type of retirement savings account where the contributions you make are tax deductible, which helps lower your taxable income for the year. Plus, Any investment growth inside the account is tax deferred until you actually withdraw the money down the road. Residential real estate involves properties like single-family homes, townhouses, and apartment buildings that people actually live in. Investors typically buy these places to generate rental income or to sell them later for a profit. The Producer Price Index tracks the average changes in prices that domestic producers receive for their output. It gives us a great early look at potential inflation trends before those costs actually reach everyday shoppers. A diagonal spread is an options strategy where you simultaneously buy and sell two options of the same type with different expiration dates and strike prices. It lets traders capture both time decay and directional movement. Companies usually split their shares to lower the price per individual share, which makes them much more accessible to everyday retail investors. It doesn't actually change the overall value of the company, but it really helps boost trading liquidity. A rental property is real estate purchased specifically to lease out to tenants in exchange for regular monthly income. It is a super popular way to build long-term passive income and grow wealth through property value appreciation. A sector ETF is an exchange-traded fund that focuses exclusively on companies within a specific industry, like technology or healthcare. It gives you instant diversification across that particular market segment without needing to buy individual company shares. A sinking fund is a pool of money you set aside gradually over time to pay for a specific future expense or debt. It is a fantastic way to handle big upcoming costs without scrambling for cash at the last minute. An ETF generates cash distributions primarily from the dividend payments made by its underlying stocks or the interest income earned from its bond holdings. When those portfolio assets receive payouts, the fund passes that cash directly back to its shareholders. The money supply really dictates economic momentum because having more cash flowing around usually boosts spending and business growth. If there is too much money printed too quickly, it can trigger inflation. So central banks constantly monitor and adjust those levels to keep everything stable. Dividend capture is a strategy where traders buy a stock right before its ex-dividend date to collect the payout and then sell it shortly after. While you can pocket the cash distribution, the share price usually drops by a similar amount on that day, so it rarely turns into guaranteed free money once you factor in transaction costs and taxes. A dividend stock belongs to a company that regularly shares a portion of its corporate earnings with its shareholders as cash payouts. It is a fantastic way to generate steady passive income while also benefiting from potential long-term share price growth. Deflation causes general price levels to drop across the board, which can actually increase the real value of cash and fixed income assets. However, it often hurts corporate profit margins and economic growth, making equity investments quite challenging during those periods. Long-term investing means buying and holding assets like stocks or funds for many years to let your wealth compound. It is a patient approach that helps you ride out short-term market bumps and build serious financial security over time. Choosing between ETFs and individual stocks really comes down to your personal strategy, since ETFs offer instant diversification while single stocks let you target specific companies. Mixing both can also be a great way to balance steady growth with some exciting high potential picks. Stagflation happens when an economy deals with sluggish growth and high unemployment while prices keep climbing at the same time. It is a really tricky economic puzzle because the usual fixes for inflation can actually make the slowdown worse. Asset allocation matters because spreading your money across different types of investments helps balance out risk and reward. It ensures that a downturn in one specific market will not completely ruin your overall financial progress. Meme stocks usually blow up because online communities rally together on social media to hype them up and drive the price way beyond standard business value. It creates a massive wave of internet momentum and fear of missing out. Stagflation is a tricky economic scenario where an economy faces stagnant growth and high unemployment while prices are still rising. Fixing it is super tough because the usual tools to fight inflation can actually make the economic slowdown even worse. Crypto prices mostly climb when buyer demand outpaces the available supply, which is often driven by positive news, wider adoption, or growing market hype. It is a very volatile space, so those big price swings usually happen fast. A down payment reduces the total amount you need to borrow, which lowers your monthly mortgage payments and helps you secure a better interest rate. Preferred stock is a special type of equity that usually pays fixed dividends and takes priority over common shares when it comes to getting paid out. It acts a bit more like a bond while still giving you a stake in the company. FIRE stands for financial independence, retire early, which is a lifestyle movement focused on extreme saving and smart investing to leave the traditional workforce decades ahead of schedule. A crypto bull market is an extended period where digital asset prices are steadily rising and investor confidence is running sky high. Everyone gets super optimistic during these phases because gains seem to pop up everywhere. You figure out your net worth by adding up everything you own, like cash and investments, and then subtracting all your debts and liabilities. It gives you a clear snapshot of your overall financial health. An inverse ETF is a specialized fund designed to go up in value when the underlying market index falls. It uses derivatives to short the market, which lets traders profit from a downward trend. Rebalancing your portfolio every 6 to 12 months is a great way to keep your target asset mix on track. It just ensures that your investments do not drift too far from your original risk goals. Momentum investing is a strategy where people buy assets that have been showing strong upward price trends in hopes the gains will keep going. It is all about riding the wave of existing market strength. Pin risk happens to options traders when an underlying stock closes right at the strike price on expiration day, leaving them totally unsure if their options will actually be exercised. Keeping about 1 to 2 months' worth of living expenses in your checking account is usually a safe bet for covering daily bills without leaving too much cash sitting idle. Home equity is simply the portion of your property's value that you truly own outright, calculated by taking your current home value and subtracting any remaining mortgage balance. A valuation multiple is a financial metric that compares a company's stock price to a specific fundamental value like earnings or revenue. It helps investors quickly judge whether a particular share is reasonably priced compared to its peers. An economic moat refers to a company's distinct competitive advantage that shields its market share and profits from rival businesses over the long haul. Economic growth is basically an increase in the production of goods and services in an economy over a specific period. It is usually measured by looking at changes in the gross domestic product. A dividend aristocrat is an S&P 500 company that has successfully increased its dividend payouts to shareholders for at least 25 consecutive years. These businesses are typically known for having very stable earnings and strong, reliable business models. Alternative investments are asset classes outside of standard stocks, bonds, and cash, like real estate, commodities, or private equity. They can add nice diversification to a portfolio. Investor sentiment is basically the overall mood or attitude of market participants toward a particular asset or the stock market as a whole. When everyone is feeling super optimistic, prices tend to climb, but fear can quickly drive the market down. The capitalization rate, or cap rate, is a metric used in real estate to estimate the net return on an investment property. You simply divide the net operating income by the current market value to figure out your potential yearly yield. An in-the-money option is a contract that currently holds intrinsic value, meaning a call option has a strike price below the market price, or a put option has a strike price above it. Real estate depreciation is a handy tax deduction that lets property owners write off the cost of wear and tear on their buildings over time. It helps offset rental income while acknowledging that physical structures naturally age. Home equity represents the portion of your property that you genuinely own, found by subtracting your remaining loan balance from the current market value of the house. Central banks, like the Federal Reserve in the United States, control monetary policy by managing interest rates and the money supply. Debt directly decreases your net worth because your net worth is calculated by taking everything you own and subtracting what you owe. So, every time you pay down a loan, you are actually building up your total net worth. An index is basically a portfolio of specific stocks designed to track the performance of a broader market segment, like the S&P 500. It gives us a great snapshot of how the overall economy is doing. A GIC, or Guaranteed Investment Certificate, is a secure savings option where you lock away your money for a set period in exchange for a guaranteed interest rate. The maintenance margin is the minimum amount of equity you need to keep in your brokerage account after buying securities on margin. If your account value drops below that threshold, your broker will issue a margin call asking for extra funds. A rainy day fund is usually set aside for smaller, unexpected expenses like a car repair, whereas an emergency fund is meant to cover major life events like job loss for several months. Crypto prices swing so wildly because the market is still pretty young and heavily driven by social media hype and speculation. Since there isn't much physical asset backing most coins yet, prices can shoot up or crash down in the blink of an eye. Tail risk refers to the chance of a rare, extreme market event happening that most traditional models completely overlook. Because these unexpected drops are so severe, investors usually try to protect their portfolios against them just in case. Accounts receivable represents the money that customers owe a business for products or services they have already received on credit. It is treated as a current asset on the balance sheet because the company expects to collect those funds in the near future. A business becomes profitable when its total revenues from selling products or services exceed the total expenses it takes to run the operation. Bringing in more money than you spend is the ultimate key to success. Options flow can give us clues about where big institutional investors are placing their bets, but it is definitely not a guaranteed crystal ball. Markets are way too unpredictable for any single indicator to tell the whole story. Revenue growth simply means a company is bringing in more sales and cash compared to a previous period. It is a huge sign that customer demand is rising and the business is expanding successfully. A non-performing loan is a credit account where the borrower has fallen behind on scheduled interest or principal payments for a prolonged period, usually 90 days or more. Lenders closely monitor these because they signal financial trouble and a higher risk of default. Fund turnover measures how frequently the managers buy and sell assets inside a portfolio over a given year. Higher turnover can lead to bigger transaction costs and tax bills, which is why many investors keep an eye on it. Execution risk is the danger that a company won't be able to successfully carry out its strategic plans or finish a big project. Things like poor management, supply chain snags, or tech glitches can all get in the way of smooth delivery. Digital currencies can be super volatile, meaning their values might drop dramatically in a very short time. Plus, the lack of heavy regulation leaves investors vulnerable to security breaches and sudden market shifts. Building an emergency fund takes time and consistency, usually ranging from a few months to a couple of years, depending on how much you can save each month. Setting aside just a small portion of every paycheck adds up surprisingly fast. A guaranteed investment certificate is a secure savings product where you lock in your cash for a set term in exchange for a guaranteed interest rate. It is a super safe way to grow your savings without risking your principal in the stock market. An apartment REIT is a company that owns and operates residential rental properties, letting everyday people invest in real estate without having to buy an actual building. It is a neat way to earn regular dividend income from housing markets. Total return is the complete measure of an investment's performance, factoring in both capital gains and any dividends or interest earned over time. It gives you the true picture of how much your money has grown. An annual percentage rate shows the yearly cost of borrowing money, including any standard fees and interest. It gives you a clear picture of what a loan or credit card will actually cost you over 12 months. Diversification is definitely not overrated because spreading your investments across different assets helps cushion the blow if one particular sector takes a hit. It is one of the smartest ways to manage risk while still chasing steady growth. Net worth is basically the total value of everything you own minus what you owe, giving you a clear snapshot of your financial health. A secured credit card requires a cash deposit upfront that acts as your credit limit, making it a fantastic tool for building or repairing your credit history safely. Diversification is a smart investing strategy where you spread your money across different types of assets, like stocks, bonds, or real estate, to reduce risk and increase potential returns over time. A lockup period is a set time frame where investors are not allowed to sell or redeem their shares in a fund. It helps fund managers keep their strategies stable without sudden cash withdrawals. Stablecoins are cryptocurrencies pegged to a reserve asset like the US dollar, which helps people avoid the wild price swings of other digital coins. They make it super easy to move funds quickly across trading platforms without worrying about sudden market crashes. A company usually does a reverse stock split to boost its per share price, so it can stay compliant with major stock exchange listing requirements. It essentially combines multiple existing shares into fewer, higher valued ones without changing the company's overall market value. Cryptocurrency prices usually go up when more people want to buy them than are willing to sell, often driven by positive news or growing adoption. It is all about basic supply and demand in the digital marketplace. Beta measures how much a stock's price bounces around compared to the overall market. A beta above 1 means the stock is typically more volatile than the market, while a lower number indicates smoother sailing. The general guideline is to spend no more than 30% of your gross monthly income on housing expenses. This helps ensure you still have plenty of room left over for saving and daily living costs. A trader usually sets up a strangle when they anticipate a massive price swing in either direction, but are unsure which way it will break. They achieve this by purchasing both an out-of-the-money call and an out-of-the-money put with the same expiration date. Tackling high-interest debt first is usually the smartest move, because those interest rates cost you more than you would typically earn in the market. Once those expensive balances are gone, you can freely channel that cash into building your investments. An option premium is simply the upfront price you pay or receive to purchase or sell an options contract in the market. It's determined by factors like time remaining, market volatility, and the underlying asset's price. A drawdown measures the peak-to-trough decline in your portfolio value during a specific period. It matters because it reveals how much potential pain you could experience before your investments recover. A credit cycle refers to the alternating waves of expansion and contraction and how easily people and businesses can borrow money. When the economy is booming, lenders loosen up and credit flows freely. But during a downturn, they tighten requirements significantly to reduce their risk. Value investing involves hunting for companies that appear to be trading below their actual worth, kind like shopping at a clearance sale for great businesses. Investors look for hidden gems with solid fundamentals and wait patiently for the rest of the market to catch on. Risk capacity refers to the actual financial ability you have to absorb potential losses without disrupting your standard of living. It is all about looking at your income, savings, and timeline to figure out how much exposure your wallet can truly handle. An ETF, or exchange-traded fund, pools money from many investors to buy a whole basket of assets like stocks or bonds, and it trades on an exchange just like a single stock. It is a fantastic way to instantly diversify your portfolio without needing to buy every individual company yourself. Equal weight investing gives every single company in a portfolio the exact same percentage share, meaning a tiny firm has just as much influence as a massive giant. This approach prevents huge corporations from dominating your returns and gives smaller stocks a chance to shine. Bitcoin runs on a decentralized digital ledger called a blockchain, which records every single transaction across a vast network of computers. Instead of relying on a bank, it uses cryptography and mining to verify transfers securely and keep the whole system running smoothly. Companies usually go bankrupt when they run out of cash and can no longer pay their debts or keep operations running smoothly. It often happens due to poor sales, too much debt, or unexpected financial trouble. Industrial production is a monthly economic report that measures the output of factories, mines, and utilities in the country. It is super helpful because it gives us a clear snapshot of how strong the manufacturing sector and broader economy are performing. A gamma squeeze happens when a sudden surge in buying call options forces market makers to purchase the underlying stock rapidly to stay hedged, which sends the price rocketing upward even faster. A decentralized exchange is a peer-to-peer marketplace where folks can trade cryptocurrencies directly with each other without needing a traditional middleman or authority. Everything runs automatically through smart contracts, giving you total control over your funds the entire time. A recession is generally defined as a significant decline in economic activity spread across the economy, lasting for more than a few months. It is typically spotted when gross domestic product drops for 2 consecutive quarters. A closed-end fund issues a fixed number of shares all at once through an initial public offering and trades on the secondary market, whereas an ETF can create or redeem shares continually to match market demand. This means a closed-end fund's price can trade at a distinct discount or premium to its actual net asset value. A company becomes tough to rival when it has strong competitive advantages, like loyal customers, unique technology, or massive cost benefits that others simply cannot match. A merger happens when two separate businesses decide to join forces and combine into a single, unified company. They usually do this to grow larger, cut costs, or expand into fresh markets together. Real estate investment trusts generate revenue primarily by collecting rental income from their diverse portfolio of properties, like apartment buildings and shopping centers. They pass most of those earnings right along to shareholders as dividends. Automatic saving works wonders because it removes the temptation to spend that cash by stashing it away before you even notice it is missing. It makes building up your savings effortless and keeps you steadily moving toward your goals. Keeping your eyes on a fun future goal, like an amazing vacation or a special purchase, makes setting cash aside feel so rewarding. The Consumer Price Index is a widely followed economic indicator that measures the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. A total market index tracks the performance of practically every publicly traded stock in a specific country, giving you instant diversification with just one single fund. Disinflation simply means that the rate of inflation is slowing down, so prices are still rising, but at a much slower pace than before. When emotions take the wheel, traders often jump on hot tips or panic sell, which can swing away from sound fundamentals and hurt returns. Staying level-headed lets you follow a well-thought plan and avoid those costly impulse moves. Most experts say it is incredibly difficult to predict exactly when the market will hit its peaks or valleys. Most people find much better success by staying invested long-term rather than trying to guess those perfect moments. A money market fund is a type of mutual fund that invests in highly liquid short-term debt instruments like treasury bills. It's often used as a safe place to park cash while earning a bit of interest. A line of credit works like a flexible loan, where you can borrow money up to a certain limit whenever you need it. You only pay interest on the specific amount you actually use, which makes it super handy for unexpected costs. Companies often buy back shares to return excess cash to shareholders, boost earnings per share, and signal confidence in their future prospects. It can also help adjust the capital structure by reducing the number of shares outstanding. REITs let you own a slice of large property portfolios without the hassle of being a landlord, and they're required to distribute most of their earnings as dividends, so you often see higher payouts. Plus, real estate holdings can move independently of the stock market, giving you a useful diversification boost. Inflation protection usually involves investing in assets like Treasury inflation-protected securities or real estate, which tend to increase in value as the cost of living rises. This helps ensure your purchasing power stays strong even when prices go up. ETFs are great because they use an in-kind redemption process to swap shares, which helps minimize the capital gains taxes that usually come with selling individual stocks. This structure allows you to keep more of your money working for you instead of losing it to the tax man. Housing prices can fall due to factors like rising interest rates, economic downturns, or an oversupply of homes, which reduce demand and put downward pressure on values. Bear markets can vary a lot. Historically, the average has been around a year and a half, but some last only a few months while others stretch over several years. The exact length depends on economic conditions, investor sentiment, and policy responses. The Dow Jones Industrial Average is a stock market index that tracks 30 large, publicly traded U.S. companies, offering a quick snapshot of overall market health. A stock exchange is a marketplace where buyers and sellers trade shares of companies, offering a regulated space that helps ensure fair prices and easy liquidity. An emergency fund is a stash of cash you keep ready for unexpected expenses like a sudden car repair or medical bill so you can avoid dipping into credit. It's usually set to cover 3 to 6 months of living costs and is kept in a liquid account for quick access. An NFT, or non-fungible token, is a unique digital item recorded on a blockchain that proves ownership of a specific piece like artwork, music, or collectibles, making it distinct from regular, interchangeable currencies. Herd behavior happens when people make choices like buying or selling stocks, following what others are doing, often driven more by emotion than by careful analysis. A debit card is a payment tool that pulls money directly from your checking account to cover purchases. It's super convenient for everyday spending since you're using your own funds in real time. Even if a company reports profits, its cash can run dry if earnings are tied up in inventory, accounts receivable, or large capital projects, or if it pays out dividends or service debt before the money arrives. Timing mismatches between revenue recognition and cash receipts often leave a profitable firm short on liquid funds. Hey, if you're looking to protect against inflation, you might consider assets like gold, real estate, or Treasury Inflation-Protected Securities, TIPS. These tend to keep pace with rising prices better than regular cash or bonds. A good trick is to set a clear spending limit for each category and stick to Idu's cash envelopes or a budgeting app to see what's left. When you feel a sudden urge, pause and wait 24 hours. That break often turns a want into a no-go. Tracking every purchase helps you spot patterns and adjust before the impulse hits again. Sequencia returns risk is the chance that the order of gains and losses in your portfolio can hurt you, especially when you're taking withdrawals. If a bad year comes early, you may use up more of your savings than if the same returns were spread out over time. Gamma exposure measures how much an options delta changes for a 1-point move in the underlying asset's price. It shows the rate of change of delta, helping traders understand how sensitive an option is to big price swings. A company that's tough to compete against often has a powerful brand, exclusive technology, or a massive network that keeps customers coming back and new entrants at bay. Good debt is typically considered an investment that can increase your net worth or future income over time. Examples include student loans for education or a mortgage for a home, since these assets often grow in value. ETF distributions usually come from the dividends or interest earned by the underlying assets held within the fund. When those companies pay out, the fund collects the cash and passes it along to you. Overdraft protection is a service from your bank that covers transactions if you don't have enough money in your account. It helps prevent declined payments, though it often comes with a fee for the convenience. A technology ETF is a fund that holds a basket of tech-related stocks like companies in software, hardware, or semiconductor. You can invest in the whole sector with just one purchase. A core portfolio is the main set of investments you hold, usually diversified across major asset classes to match your long-term goals. It's the foundation you build on, with a mix of stocks, bonds, and sometimes cash, and you add or tweak it as you go. An inverted yield curve when short-term rates rise above long-term ones has historically been a strong early warning that the economy might slow down, as investors anticipate lower growth and future rate cuts. It's not a certainty, but it's one of the most closely watched signals for potential recessions. A bank deposit is when you put money into a bank account, like a savings or checking account, and the bank keeps it safe for you. It's a secure way to store your money, and sometimes you even earn a little interest on it. Time value refers to the idea that money available now is worth more than the same amount in the future, due to its potential earning capacity, like earning interest or investment returns over time. A deep in the money option is one whose strike price is far below the current price of a call, or above for a put. So it already carries a lot of intrinsic value and a high chance of finishing in the money. Inflation erodes purchasing power, so the same dollar buys less over time. It can push up living costs, squeeze savings, and shift how you budget. Staying ahead means tracking rates, adjusting spending, and considering investments that keep pace. Compound interest is so cool because you earn interest not just on your original money, but also on the interest you've already accumulated. It creates a snowball effect that can really boost your savings over a long period of time. A rate cut happens when a central bank lowers the interest rate it charges banks, making it cheaper for businesses and consumers to borrow money. This usually sparks more spending and can help boost economic activity. Tokenization is the process of converting rights to an asset into a digital token on a blockchain. This allows people to trade fractional pieces of things like real estate or art much more easily. A token is a digital unit of value or access that lives on a blockchain. It can represent anything from currency to ownership rights, like a piece of art or a share in a project. When a company stops paying dividends, it's usually because they want to save cash to pay off debt or reinvest in new projects. This can sometimes make investors a bit nervous since they were counting on that regular income. An option spread is a trading strategy where you simultaneously buy and sell options of the same type on the same underlying asset, but with different strike prices or expiration dates. This setup limits your potential loss while also reducing the overall cost of the trade. A strangle is an option strategy where you buy a call and a put with the same expiration but different strike prices, usually out of the money, to profit from a big move in either direction. It costs less than a straddle because the strikes are farther apart, but you need a larger price swing to break even. The goal is to capture volatility without betting on a specific direction. Factor-based ETF investing means buying exchange-traded funds that target specific drivers of returns, like value, momentum, or low volatility, to try to outperform the market or manage risk in a rules-based way. Real GDP measures the total value of all goods and services produced in a country during a specific time, adjusted for inflation. This helps us see if the economy is actually growing or if prices are just rising. ETF tracking error is the difference between how an ETF performs and the index it's supposed to follow. It happens because of fees, how the ETF is managed, or market changes, but a little bit of error is normal. A pause in monetary policy is when a central bank stops adjusting interest rates or other tools for a while, keeping them steady to let the economy settle and assess conditions. It's like taking a breather before deciding the next move. An ETF premium happens when the market price of an exchange-traded fund trades higher than the value of its underlying assets, meaning investors are paying extra for the fund's shares. This can occur due to high demand, limited supply, or expectations of future growth. When the premium is large, it may signal that the ETF is overvalued relative to its net asset value. Beta is a number that tells you how much a stock's price tends to move compared to the overall market. If it's above 1, the stock usually swings more. If it's below 1, it's a bit calmer. It helps investors gauge risk relative to the market's ups and downs. A bond ETF is a basket of different fixed income securities that lets you invest in a whole bunch of debt instruments all at once. It's a super easy way to get instant diversification without having to buy every single individual bond yourself. A bank deposit is basically when you put your money into a financial institution for safekeeping. It's a super secure way to hold your cash while potentially earning a little bit of interest. A stock represents a tiny piece of ownership in a company. When you buy shares, you're essentially becoming a partial owner, which means you can potentially benefit if the business does well. A secured credit card works like a regular card, but you put down a cash deposit that becomes your credit limit, so the bank has a safety net. By using it responsibly and paying on time, you can build or rebuild your credit score. Gamma exposure measures how much an options delta changes when the underlying asset's price moves. It's the second derivative of the option's value with respect to that price. A higher gamma means the options delta will swing more sharply as the market shifts, making the position more sensitive to price changes. Traders watch gamma to gauge how quickly their hedges might need adjustment. Penny stocks are risky because they often come from small, less established companies with low trading volume, making them super volatile and easy to manipulate. Plus, there's usually less public information, so it's harder to know what you're really investing in. Higher interest rates increase the amount of interest you pay each month, so more of your payment goes toward interest and less toward the principal, raising the total cost of the loan. Lower rates do the opposite, letting you pay down the principal faster and save money overall. Annual percentage rate, or APR, is the yearly cost of borrowing money, expressed as a percentage. It includes interest and certain fees, so you can compare loan offers more easily. Trying to predict exact market turns is incredibly difficult because so many unpredictable global events can shift prices instantly. Most experts suggest that staying consistently invested is usually more effective than trying to guess the perfect moment to jump in. Buy Now Pay Later lets you get a product right away and split the cost into interest-free installments over a set period. You usually sign up through the retailer's checkout, and the service handles the payment schedule. It's handy for budgeting, but watch out for hidden fees if you miss a payment. Real estate investment trusts can be tricky because their value often fluctuates based on property market trends and interest rate shifts. You also have to keep an eye on the specific types of buildings they own, since a downturn in office spaces might affect them differently than residential ones. A quality stock typically belongs to a company with strong, consistent earnings and a solid competitive advantage in its industry. These businesses usually have manageable debt and a history of steady growth, making them much more reliable for long-term investors. An IRA, or individual retirement account, is a savings account with tax advantages designed to help you save for retirement. You can contribute money each year, and depending on the type traditional or Roth you, get tax benefits either now or when you withdraw in retirement. Commercial real estate refers to properties used for business purposes like office buildings, retail spaces, or warehouses rather than homes. Investors earn income from rent or property value appreciation, making it a popular way to diversify beyond stocks. FOMO, or the fear of missing out, can lead people to rush into investments just because they see others making quick profits. This impulsive behavior often results in buying assets at their peak prices, which can lead to significant losses when the market corrects. A leveraged buyout is when a buyer acquires a company primarily using borrowed funds, often putting the target's own assets as collateral. The goal is for the company's future cash flow to cover the debt and still generate profit for the new owners. A balance transfer is when you move high-interest debt from one credit card to a new one, usually with a much lower interest rate. It's a super helpful way to pay down what you owe faster without all that extra interest piling up. There isn't one magic number since it depends on your lifestyle and expected lifespan, but many experts suggest having about 25 times your annual spending saved up. It's all about calculating your future expenses and ensuring your investments can cover them comfortably. An income statement, also called a profit and loss statement, lists a company's revenues, subtracts its expenses, and shows the resulting profit or loss for a specific period. When workers earn more, they tend to spend more, boosting overall demand for goods and services. If supply can't keep up, prices rise, creating inflation. Additionally, higher wages raise production costs for companies, which they often offset by raising product prices. So, rising wages can be a key driver of inflation when matched with strong consumer demand and limited supply growth. Bitcoin is a digital currency that runs on a decentralized blockchain network, letting people send and receive money without a central bank. Transactions are verified by miners and recorded in a public ledger, which keeps the system secure and transparent. Inflation protection involves investing in assets like gold or real estate that tend to hold their value even when the cost of living rises. These options help ensure your purchasing power stays strong over time. And a T-money option is a contract whose strike price equals the current market price of the underlying asset, meaning exercising it would give you no immediate gain or loss. A budget is a plan for how you want to use your money. It helps you keep track of your income and expenses so you can make smart financial decisions. Disinflation means the pace of price increases is slowing down, so inflation is still positive but moving more slowly. It's not a price drop, just a gentler rise in costs over time. Needs are things you must have to live, like food, shelter, and healthcare. Wants are extras that make life nicer, but aren't essential, like streaming subscriptions or fancy gadgets. Knowing the difference helps you spend wisely. Subscription revenue is the income a company gets from customers who pay a regular fee, often monthly or yearly, to access a product or service, like a streaming platform or a software subscription. Net margin is the percentage of revenue that remains as profit after all expenses like taxes, interest, and operating costs are subtracted. It shows how efficiently a company turns sales into actual earnings. Paying more than the minimum on debt, like credit cards, helps you reduce the principal faster, which cuts down on interest over time and gets you debt-free sooner. A sector ETF is a type of exchange-traded fund that focuses on a specific industry or sector, like technology, healthcare, or energy. It lets you invest in a basket of companies within that sector all at once, making it easier to diversify within a particular area of the market. That's a great question. What are your thoughts on it? A hard inquiry happens when a lender reviews your credit report to make a lending decision, which can temporarily lower your score. It's different from a soft inquiry, which is just a quick check that doesn't impact your rating. When markets drop drastically, panic often takes over and people sell out of fear of losing even more money. Others might sell because they urgently need cash or are forced to cover margin calls during the downturn. A grace period is the extra time you get after a payment's due date before a late fee or penalty kicks in. Think of it as a short buffer to catch up without extra cost. Net operating income is the money a property or business makes after covering all operating costs like maintenance, utilities, and management, but before paying taxes or interest. It's a key figure for judging how well an investment is performing. An earnings straddle is a trading strategy where you buy both a call and a put option on the same stock, with the same strike price and expiration, to profit from a large price move around an earnings announcement, regardless of direction. A long-term financial goal is something you're working toward over several years or even decades, like saving for retirement, buying a home, or funding a child's education. It requires consistent planning and discipline to achieve. Paying off a mortgage ahead of schedule can save you a bundle on interest over the years, though you might miss out on potentially higher investment returns elsewhere. It really comes down to your personal comfort with debt and what brings you peace of mind. A stock exchange acts like a centralized, A covered call is an option strategy where you hold shares of a stock and sell call options on those same shares to generate extra income. It is a neat way to make a little extra cash on stocks you already own. A bank run usually happens when widespread panic. That's a great question. What are your thoughts on it? That's a great question. What are your thoughts on it? A collar strategy is an options approach where you buy a protective put and sell a covered call at the same time to limit both your potential losses and gains on a stock. A classic rule to live by is the 50-30. That's a great question. What are your thoughts on it? Alternative investments are asset classes that go beyond traditional stocks, bonds, and cash, such as real estate, private equity, or commodities. They can offer great diversification for a portfolio. A consignor is someone who agrees to take on the legal responsibility for a loan if the primary borrower is unable to make their payments. It gives lenders extra peace of mind. During an economic recovery, business activity starts picking back up, jobs slowly return, and consumer spending begins to grow again after a downturn. Data measures time decay in options trading, showing an RRSP is a special kind of savings account meant for your retirement that also gives you some nice tax breaks while your money grows. The PEG ratio takes a company's PE ratio and divides it by its expected earnings growth rate, helping us see if a stock is fairly priced relative to how fast it's growing. Companies usually split their shares to lower the price per share, making it much more affordable for everyday investors to buy in. It doesn't actually change the company's overall market value, just creates more shares. Options flow refers to tracking large, unusual trades made by institutional investors, which can give us a hint about where smart money might be moving. It is like peeking at the big players' moves to see what they are betting on. An annual percentage rate, or APR, represents the yearly cost of borrowing money, including any fees and interest combined into a single percentage. Vacancy rate is simply the percentage of all available rental units that are currently unoccupied in a specific area. Property managers and investors watch this closely to gauge market demand and health. capital gain is the profit you pocket when you sell an asset for a higher price than what you originally paid for it. Reviewing your credit report regularly helps you spot any errors or signs of identity theft early on. Plus, it lets you see how lenders view your financial health. Leveraged ETFs use borrowed money and financial derivatives to multiply their daily returns, which can quickly magnify losses just as easily as gains if the market moves against them. Because of how they reset every single day, holding them for the long term can really eat away at your principal. Cash-on-cash return is a helpful metric that compares the annual pre-tax cash flow you receive to the actual cash you initially invested in a property. It really helps real estate investors see how efficiently their invested cash is generating income. Real estate investment trusts, or REITs, primarily earn revenue by collecting rent on the diverse properties they own and manage. They then distribute a large portion of those earnings back to shareholders as regular dividends. Return on assets is a handy financial ratio that tells us how efficiently a company uses its assets to turn a profit. It is calculated by dividing net income by total assets, giving us a clear picture of management effectiveness. EV to EBITDA is a popular valuation metric that compares a company's total enterprise value to its earnings before interest, taxes, depreciation, and amortization. It helps investors see how pricey a business is relative to its core cash generation. Cryptocurrency values swing so wildly because the market is still quite young and driven heavily by speculation, news, and shifting sentiment rather than steady business earnings. Even small shifts in trading volume can cause massive price movements up or down. A margin call happens when your broker demands extra funds or securities because the value of your account has dropped below a required minimum. It essentially forces you to deposit more cash or sell assets immediately to cover those borrowed losses. A competitive moat is a unique advantage that allows a business to protect its market share and fend off rivals over the long haul. Think of it as a strong business shield, like brand loyalty or high startup costs, that keeps competitors at bay. Compound interest works wonders because it lets you earn returns not just on your original money, but also on the accumulated earnings from past periods. It basically creates a wonderful snowball effect that helps your wealth grow faster over time. The bid-ask spread in options is the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. It gives you a quick look at market liquidity for that specific contract. A stablecoin is a type of cryptocurrency designed to maintain a steady value by tying its price to an external asset like the US dollar or gold. This price peg helps protect holders from buy and hold investing is a strategy where you purchase assets like stocks and keep them for the long term, ignoring short-term market dips. It is a super chill way to let your portfolio grow steadily over time. A pension is a retirement plan where an employer puts money aside for an employee, so they receive regular income after they finish working. Contrarian investing is a strategy where you actively buy assets that are currently out of favor with the general public. It takes a lot of patience, but the goal is to profit when the broader market eventually swings back around. ETF creation and redemption is the clever mechanism authorized participants use to keep the fund's market price closely aligned with its underlying asset value. They bundle up baskets of securities to create new shares or trade shares back for the underlying assets when demand shifts. Herd behavior in the market happens when investors blindly copy what everyone else is doing instead of doing their own research. It usually leads to wild buying or panic selling driven purely by crowd momentum. For me, the absolute biggest lesson is realizing how powerful consistency is when saving early. Even setting aside just a tiny amount regularly makes a huge difference over the years. Tackling high-interest debt usually comes first, since those interest charges cost you more than typical market returns. Once those costly balances are gone, shifting your focus toward investing helps your money start working for you. Payment history carries the most weight in your credit score because lenders want to see proof that you consistently pay your bills on time. Keeping that record spotless is the absolute best way to show you are a reliable borrower. Gross margin is the money a company keeps after paying the direct costs associated with making its products. It shows how efficiently a business is producing its goods. Position sizing is all about figuring out how much of your total money to put into a single trade to manage your risk. It helps make sure one bad bet will not wipe out your whole account. Market cap weighting is an indexing method where companies with a bigger total stock market value get a larger slice of the fund. It means industry giants have a much stronger influence on the index's overall performance than smaller firms. A balanced fund is a type of mutual fund that holds a mix of both stocks and bonds in its portfolio. It is designed to give you a nice blend of growth and income while helping to cushion your investments against market bumps. A portfolio hedge is basically like an insurance policy for your investments, designed to protect you from sudden market downturns. It helps limit potential losses by taking an offsetting position in another asset. A growth stock is a share in a company that is expected to grow at an above-average rate compared to the rest of the market. These businesses usually reinvest their earnings into expansion rather than paying out big dividends. Bitcoin is definitely a hot topic, but it tends to be much more volatile than traditional assets. Whether it fits into a long-term plan really depends on your personal risk comfort and overall financial goals. Free cash flow tells you the actual cash a business has left over after paying its daily bills and equipment costs. Investors love checking it because it shows real financial health and money available for dividends or growth. Cash flow is super important because it shows whether a business actually has enough money coming in to pay its bills on time. Without a clear picture of that liquid cash, even a profitable company can run into trouble. Dividends give you regular cash payments while you hold the stock, whereas capital gains happen when you sell your shares for a higher price than you bought them for. Both are great ways to make money, so it really comes down to whether you prefer steady income right now or long-term growth. Yield curve inversions happen when short-term bonds pay more interest than long-term ones, which has historically been a pretty reliable warning sign for an upcoming economic slowdown. An investment bank helps companies raise capital by underwriting new stock and bond issues, while also guiding businesses through big mergers and acquisitions. Your savings rate is simply the percentage of your take-home pay that you manage to save rather than spend each month. Building this habit up is a fantastic way to secure your financial future and reach your goals faster. A crypto wallet is essentially a digital tool that lets you securely store, send, and receive your digital currencies. It keeps your private keys safe, so only you can access your funds on the blockchain. Leverage in real estate means using borrowed money, like a mortgage, to buy a property so you can control a larger asset with a smaller amount of your own cash. It can definitely amplify your potential returns, but it also increases your risk if the property value drops. Risk tolerance is all about figuring out how much financial ups and downs you can comfortably handle without losing sleep. It usually depends on your timeline, financial goals, and how you feel seeing your portfolio dip temporarily. Unusual options activity happens when a massive volume of options contracts is traded suddenly, which often signals that big institutional investors are making a major move. It is definitely worth keeping an eye on because it can hint at upcoming price spikes or drops. A bond ETF is a basket of different bonds that trades on an exchange just like a regular stock. It is a super convenient way to diversify your fixed income holdings without needing to buy individual bonds yourself. Monetary policy is typically managed by a country's central bank, like the Federal Reserve in the United States. They make key decisions on interest rates and money supply to help keep the economy stable. Proof of stake is a consensus mechanism where blockchain transactions are validated by people who lock up their crypto tokens as collateral. It is a super energy efficient alternative to traditional mining. Investors typically figure out what a company is worth by looking at its financial health, future earnings potential, and comparing it to similar businesses in the same industry. Metrics like the price-to-earnings ratio are super popular for getting a quick snapshot of value. A growth stock belongs to a company that is expected to increase its sales and profits at a much faster rate than the overall market. These businesses usually reinvest their earnings into expansion rather than paying out big cash dividends, which is why they are super popular for long-term investors chasing high returns. Revenue is the total amount of money a business brings in from selling its goods or services before any expenses are subtracted. It is basically the top line on the income statement and shows how much demand there is for what the company offers. A trading edge is simply a unique strategy or advantage that gives you a better statistical chance of winning trades over the long run. It is what separates successful traders from the rest by keeping the odds tilted in their favor. Historically, bull markets tend to last much longer than bear markets, often running for several years on average. They are driven by strong economic growth and rising investor optimism. Payment history is super important because it shows lenders whether you have a solid track record of paying your bills on time. It is actually the biggest factor that makes up your credit score. Fundamental weighting is an index strategy where companies are ranked based on economic size factors like sales, cash flow, and dividends, instead of just their market capitalization. It is a neat way to build a portfolio by focusing on real business fundamentals rather than stock price hype. A recession-resistant business provides essential. Volatility is basically a measure of how sharply and quickly asset prices bounce around in the market. When a stock has high volatility, it means its value is swinging up and down rapidly, which can bring both big opportunities and higher risks. When demand for a product goes way up while supply stays the same, sellers can usually charge higher prices because so many people want it. On the flip side, if nobody is buying, prices tend to drop so companies can clear out their inventory. Investment banks help companies raise capital by underwriting new stocks and bonds, and they also provide expert advice on big mergers and acquisitions. They basically act as the financial matchmakers and advisors for corporations and governments. A buy now pay later service lets you purchase items immediately and split the total cost into smaller, manageable installments over time. It is a super convenient checkout option, but you definitely want to keep track of those due dates to avoid any unexpected late fees. A cash-secured put is an option strategy where you sell a put contract and set aside enough cash to buy the underlying stock if the price drops below the strike price. It is a neat way to potentially pick up shares at a discount or collect some extra premium along the way. Recession-resistant companies sell goods and services that people truly need no matter what the economy is doing, like groceries, healthcare, and utilities. Because demand for these essentials stays steady during tough times, these businesses tend to weather economic storms much better than others. Emotions like fear and excitement often lead people to make impulsive money choices rather than sticking to a logical plan. Being aware of those mental biases is key to staying calm during market swings. Maximum drawdown measures the biggest peak-to-trough drop an investment experiences before reaching a new high. It really highlights the worst possible historical loss you could have suffered if you bought right at the top. Fund turnover is the rate at which a mutual fund, or ETF, buys and sells its portfolio holdings over the course of a year. Keeping an eye on that percentage helps you understand potential trading costs and tax implications. Gross domestic product measures the total monetary value of all finished goods and services produced within a country over a specific time period. It acts as a primary gauge to tell us if the overall economy is expanding or shrinking. A credit bureau is an agency that collects your financial history and payment habits to create credit reports for lenders. Banks and other institutions check these reports to see how reliably you borrow and pay back money. A short squeeze happens when heavily shorted stocks suddenly start rising in price, forcing pessimistic traders to frantically buy shares back to cut their losses. That sudden rush of frantic buying pushes the stock price even higher in a massive upward spiral. A blue chip stock belongs to a massive, well-established company with a stellar reputation for financial stability and reliability. These industry giants usually pay steady dividends, making them a popular choice for conservative portfolios. Recession-resistant businesses offer everyday necessities like healthcare and groceries that people rely on regardless of economic conditions. Because demand for these vital goods remains constant, these companies easily weather economic downturns. An acquisition happens when one company buys most or all of another company's shares to take control of it. Big corporations usually do this to expand their market reach, grab new technology, or cut down competition. Exchange-traded funds give investors instant diversification by bundling a whole bunch of different assets into a single trade, which helps lower overall risk. Plus, They usually feature lower management fees compared to traditional mutual funds, making them super cost-effective for the long haul. Capital appreciation simply means an increase in the market value of an asset over time. When your shares or property become worth more than what you originally paid for them, that extra growth is your capital gain. That's a great question. What are your thoughts on it? Young investors often have more time to ride out market fluctuations, so taking calculated risks can potentially lead to higher returns over the long term. One of the biggest investing mistakes is trying to time the market, as it can lead to missed opportunities and significant losses if not done correctly. That's a great question. What are your thoughts on it?